the dip and rip hasn't happened. It's been more sort of rip.
You know, it's an interesting time because no one expected what happened in the first half.
What's important is what's really dragging up the market and how much more can that go.
You have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
I wouldn't chase this rally too much. I would stick to your plans.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market just about negative 0.4% on the S&P 500. Pushing forward from here into payrolls tomorrow. TK a little bit later this morning. Jobless claims. We'll get some data as well from ADP, job openings, all of that stuff. But we kick off this morning distracted by a new app from Mark Zuckerberg.
We've been
and Instagram.
Here. If you guys could see us big little here 2 minutes before John's like, can you open Tom? I'm on Instagram.
What do you make of this one? What do you make of this?
I make it's a huge deal. I'm guessing I could well be wrong. I defer to Alex Webb on this, but I think it's a huge deal. It's about the fabric of the nation, about our social network, and we'll have to see where it ends up. To get back on track here, this is an important Thursday. We've got the right guest to lead off, George Goncalves, to give us wisdom. John, I'm sorry, into jobs, into all this economic data, we have a new rate structure this morning.
It's amazing, isn't it? It's not just the Treasury market getting back somewhere close to 5% on a 2-year. It's also in the United Kingdom, the gilt market. Do you remember the drama of the end of September last year in the UK when gilt yields were in and around 470? 2-year right now, 545. And we're talking about potentially bank rate over at the Bank of England going through 6 and maybe getting to 6.5 at some point in the next 9 months. Pretty phenomenal stuff developing.
I get the drama of 6% chit-chat. And, folks, this is really important if you're in the stock market as well. But we're just going to focus on the tea leaves this morning. We go into Thursday compressed economic data, claims and the rest of it, and into jobs tomorrow with a 10-year real yield, which is almost on the edge of a reset to a higher inflation-adjusted yield. John, a 30-year mortgage jump condition over the last 6, 7, 8 days since you were on Island 4 in Italy from a 7.05 out to 7.21% this morning.
Is that biting yet? Who's paying it? I saw some stats around apartments in New York City, luxury apartments, some of the new stats. The amount of people, Tom, just paying in cash. Now, if you've got cash, great.
It's not America.
It's not the rest of the country. But, Tom, the rest of the country, for a lot of people, did remortgage. They have locked in these very low interest rates for a long, long time, pushing it out, say, 30 years. How much of this interest rate structure that you describe is actually starting to bite?
I think it's starting to bite geographically and always in the real estate business, particularly in retail and individual. You look to the West. I'll be interested to see what the rent dynamics are in the West. I believe the statistic right now is a negative 6% on year-over-year rent out California, Arizona, and that's sort of the front of what's to come.
Lizanne Saunders coming up a little bit later this hour, I believe in about 28 minutes on the equity market.
She's
Don't
on
miss that
Threads right now.
We'll find out if she is on Threads. I'll tell you what, Tom, Elon Musk snapping back already on this. It is definitely preferable to be attacked by strangers on Twitter than indulge in the false happiness of hide the pain Instagram. What do you make of that take of Instagram?
Does Zuckerberg have 10 homes or is it Musk that has 11 homes? I mean, it's surreal. And, you know, we're going to be unbiased on this. John and I are going to kill ourselves not to give an opinion on this. We'll let others do that. But I'm sorry, they're launching this thing after all this, 1 year uproar.
If you're creditors to Elon Musk and this platform, I think you're taking this pretty seriously this morning, Tom. I really do think you are.
Yeah, I believe Morgan Stanley, I don't have it in front of me, but I think Morgan Stanley was involved in that transaction. And they got to be waking up. You know, they're going, Ellen Zentner, are you on Threads, Ellen? You know, be careful.
Do you remember Clubhouse?
No.
That lasted like 5 minutes, so...
What was the one before Facebook?
Of course, this is very different.
MySpace?
MySpace.
Very good.
MySpace.
Yeah. You know, it's way back.
You think Twitter might go in the same way as MySpace?
I don't have an opinion. All I know is I just signed up for Threads. And I'm rolling. I got the photo up there. The dogs are on. You know, I mean, vet building, kennel fee are on. It's great.
Oh, you're doing dog content on Threads?
Oh, yeah.
Okay, so you won't do markets.
Well, no,
just
their
content.
handlers have it. I don't do it.
Okay. We'll catch you with Dan Ives of Wedbush on this a little bit later this morning as well. Let's get you up to speed on the price action. Equities right now, negative 0.4%. Bit softer negative here. Snap at a 3-day winning streak on the S&P just yesterday. Bond yields higher. Again, we're looking at 4% on a 10-year, up 4 basis points to 108.97. And looking at the FX market, the euro actually showing some strength now, 108.65. A bit of weakness yesterday, Tom, on the euro side of things.
Quickly, Mexican peso printing through 17. Never did I think I'd see this. Think about Mexico, an election 2 ago, 21-22. Mexican peso goes through 17.0.
What's happening over there?
I just think it's the adjacency to the American boom is my short answer. Plus, all of Latin America is doing well.
George Concalves joining us now, head of US macro strategy over at MUFG. George, wonderful to hear from you, sir. We all read the minutes yesterday. Some of us did, at least. I think TK gave that one a miss.
Threads.
But George, I think the question I've got to ask you is how significant is the division emerging on the FOMC?
Look, I don't think it's significant yet. I mean, the commentary that we got after the minutes probably mattered more. I mean, like they're going to hike in July most likely, unless something really derails it from here till then. But I do think there was some important pieces in the minutes that are worth mentioning. They're starting to focus on, although inflation is, they're highly attentive, and that's the main focus of theirs. It continues to be, but they are starting to focus on some of the growth factors, like the fact that GDI is diverging from GDP. I'd never expected to see that in the Fed minutes, and the focus on like the BLS data maybe is over counting jobs. So I think the Fed's starting to think about how robust is this recovery at this stage.
George, thrilled to have you on today. Just the right guest at the right time. I want to focus on the inflation-adjusted yield. Our listeners and viewers, it's not a common statistic. It's at 1.73, ballooning up for 1.58. Where is your pre-pandemic normal on the real 10-year yield?
On the real 10-year yield, I think we're surpassing it. I mean, we're actually getting back to levels that we're seeing pre-GFC. I mean, if we were to make a move towards 2%.
Agree. So what is the level here where the tension, where it begins to fall apart?
Look, so in any other time period, because we've been operating with these huge lags that have been, kind of this liquidity buffer has been allowing markets to ignore the real rate. But if the real rate continues to march higher like it has been, I think that financial markets will take notice pretty soon.
George, you expecting a hike then in several weeks? Just to be clear, just to start there.
Yes, I do think that, given the language as well as what's priced into the market, it will take a lot to derail a hike.
And the next one after that, George, you expecting another one after that? Because there's a lot of people that think maybe they go in July, perhaps they're done. Others look at the FOMC and what the committee is communicating right now and see another one in our future.
The one that follows, I think it's really going to be about financial conditions. I mean, we're starting to see more tightening, and I think this real rate channel is important that Tom's highlighting. So I think if we were to continue to see the overall rate structure move higher, let's not forget that since last year, the 10-year in general has traded well under the Fed funds market. And so if we get a kind of normalization or a catch-up, even if it's a brief catch-up, like an anti-seasonal rise in rates, which people call a bear steepener, which we had a little bit of that yesterday and a little bit this morning, I think that really matters. I mean, that will be where tightening takes place, because we've had rates under, and that's really helped out the housing market. So if we were to continue to see a rise in 5-year, 10-year rates, I think that would be a game changer.
Well, George, let's build on that. Let's go further out the curve. The Federal Reserve right now is communicating a couple more hikes. You seem to be on board. Potentially, that's going to develop. The Federal Reserve is also communicating at the same time, simultaneously, a mild recession, potentially in the second half. What should a 10-year be doing in the world that the Federal Reserve is projecting?
Well, I mean, it depends what kind of inflation, what kind of recession we get. I mean, we have this, we have about 15-20% risk of a stagflation, which has never been really in the cards for U.S. economic forecasting. But I think that stagflation risks are out there. That at some point, if the Fed can't really get inflation under control, I mean, you're seeing similar situations with the BOE. I mean, you could raise rates to 10%, and it might take longer to get inflation down, and all you're going to do is crush the economy. So I mean, it really comes down to like a stagflation recession nuance.
How does a yield curve disinvert? What are the threads of like that, John? Thank you.
Sure, that was nice. What are the
threads of information that allow us to disinvert, say, from negative 105 to say negative 40, negative 30?
So traditionally, it's always been the Fed cuts rates. I mean, if the Fed were to cut rates 200 basis points, the 2-year would move much faster than the 10-year for sure. Bear steepeners are kind of like unicorns, really hard to find. They're very rare. When they happen, they're short-lived, but they're very painful. So a rise in long-term rates, we haven't really seen that happen on a consistent basis. So it would have to come from the front end.
This is critical, George. And, with MUFG and the Japanese affiliation, you've got first-order knowledge on this, domain knowledge on this. If the long-term yields are lower, Is that pricing up, yield down by foreign buyers of full faith and credit U.S. paper?
At this juncture, really, I mean, look at the actual public flows and see what's going on. This has really been a domestic-driven bond market. It has been for quite some time. We've seen less and less foreign influence for years, and so, and especially in the last number of months, I do think that most of this will have to be taken down. The supply that the U.S. government's bringing to market, a lot of it will have to be taken down by domestic investors. I mean, foreign investors obviously play a critical role. But I just think that, given where funding costs are and everything else that's going on, and more importantly, now the U.S. Treasury has competition from other markets. Other sovereign markets are yielding higher as well. So, and we don't know what the BOJ is going to do with its own policy, which then might make JGBs more attractive at home. So I think that the level of rates, the curve maintaining its steepness is something that I think is going to be critical, even when the Fed starts cutting rates later on.
What is your strategy as a bond portfolio? Take a full faith and credit portfolio. What is a duration strategy? Do you barbell? Do you ladder? Do you single point? Do you go to cash? What do you do?
I mean, I think you have a bias of a ladder, but with a misweighted. I do think that at some point, if the Fed keeps raising rates, we have an attractive front end. So I mean, your risk reward is how much downside can you get if rates were to move another 25, 50 versus them going down 100 or 200, right? So the risk reward has changed. And you have to look for plays that are more convex. The mortgage rates and mortgage markets, mortgage bonds specifically, as rates rise, would also be much more attractive.
George, this was fun. Anything but boring right now in the bond market. George Goncalves there of MUFG. The high of the session on a 2-year 4.98. Tom, I'll try and get my words out.
Do it until you
4.98 probably would be better. 4.98 is the high of the session. That's also incidentally the high of the week, just short of where we got to in early March, which is 5.08%.
Small matter. While you were gone, we had West Texas Intermediate, I think, with a 68 print, even a 67, 66 print. And we've come back smartly. We've got a 72 level on West Texas Intermediate. Brent out, rounded up $77. It's not a tangible move, but it's a little bid to the system, which is a change from a week or 4 weeks ago when you left.
One more hike, two more hikes, TK. Ultimately, what's next after that? I think it's really interesting. This Federal Reserve is communicating a couple more hikes in a mild recession, and the equity market seems to be taking it pretty well.
When the facts change, Jerome Powell will change. You get yields going here, and the mortgage rate. It's like somebody, I think Ed Hyman mentioned the other day. What a great conversation with Mr. Hyman. As gloomy as he's ever been on the recession. And he said, you know what? It's still about a gallon of gas. And so, you get gas to go, 80, 90 on Brent crude. What does that do to a gallon of gas? All of a sudden, the political pressures change. Forget about all the macro babble. It's about...
Oh, I'm with you. I'll talk about the politics in the UK right now. Wow. Looking at this rate move.
You have to translate
developing at the moment. Pretty incredible. Some real pressure developing over there.
Let's digress here because, I bust John's chops, folks, but his work during Brexit was absolutely freaking brilliant. John, is it just a given that Labour takes over? When do they have an election? We have it the first Tuesday of November. We know what's coming.
We know when it has to come by. We don't know when it will be, so to speak. So we have a decent idea of when it's got to take place.
Mr. Sunak controls that decision?
He's going to have that decision to make. And ultimately, Tom, at the moment, going by the polls, and this is not my judgment, just based on the polls, Keir Starmer gets in.
It's amazing.
The Labour Party gets in. And you have to wonder how things get better from here. Can they get worse at the moment? Just in terms of the rate structure, we can talk about what's happening with the economy. The economy has surprised to the upside, Tom. Just to be clear on that, that's important. It has surprised to the upside. Whether people actually feel that way, and that distinction, Tom, between the economic data and how people feel has been a topic of discussion for us for a number of months.
Take us out. I got to go to Threads.
You're busy on Threads?
I'm busy on Threads.
Okay. It's good to be back. You going to give me a break on taking time off yet? No?
I don't know. I'm thinking of taking 6 hours off in August.
Equities right now. Futures. Slightly negative. I might join you. From New York City this morning. Good morning. This is Bloomberg.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense. We can take some time and assess and collect more information. and then be able to act, knowing that we also, have communicated through our projections that we don't think we're done based on what we know.
John Williams there, the New York Fed president, just a touch of Fed speak following the Fed minutes yesterday, indicating one more hike could well come in July, and a truce maybe, an agreement that was struck on the committee, a divided committee, to skip the June meeting, wait for a bit more data. The problem, Tom, at the moment with the data front is that we only have one more payrolls report, that's tomorrow, and one more CPI report, that's next week, and then it's bring on July.
I really thought about this a lot over the last week, and what this is really about, John, is we were ultra-accommodative, then accommodative, and some form of neutral. And I think even, for example, Bill Dudley or Andrew Hollenhorst would agree with Ed Hyman. We're there to the tension point where each decision has really significant weight. And this July meeting, whatever they decide, it's not a small matter.
Andrew, coming up later, by the way, says hike in July, hike in September.
Yeah.
Tom, it was curious to me that in the minutes, there were people who were basically dissenting but didn't dissent. What do you make of that? I don't understand why the Federal Reserve,
where do you want to start with
unlike the Bank of England, won't just come out and say, you know what, I disagree with the decision, I thought we should have hiked at this meeting. What's all that about? Why do they have to show some kind of united front in public all the time? What for?
This is a legacy, and I'm going to go to the gentleman from the Washington University of St. Louis. His name is Lawrence Meyer. He wrote a beautiful monograph in Modest Fury years ago about how Greenspan controlled the Eccles building. And there's one chapter in there which begins the heritage of how we're different from the Bank of England and, frankly, from the ECB. It was Greenspan saying, we're all on the same page, and I've got the voice. You guys can show up and give me wisdom. But my good friend Alan Greenspan said, I'm the one in charge. And the legacy of that is there, and Lawrence Meyer brilliantly described it from 25 years ago.
An agreement between the Doves and the Hawks at the last meeting to say basically we'll skip this one, project more to come, and maybe agree to hike at the next meeting, which is just a few weeks away. If you are just tuning in, welcome to the programme. Equity shaping up as follows on the S&P 500. Just a touch softer. We're negative here by 0.4%. The event of the moment for international relations, Secretary Yellen touching down, Tom, in Beijing today for conversations with her counterparts in China.
We need to go out and find somebody qualified here, and the qualities are that Chair Yellen is Chair Yellen, Secretary Yellen is Secretary Yellen, who is expert on China, that's worked at the Fed and also worked at the Treasury Department. He is Michael Herson of Eurasia Group, now head of China Research at 22V Research. Michael, in the zeitgeist on Yellen's trip, what's the thing most off the mark? What do we need to know that's germane, that's not being reported right now?
That's a good question. I think what's most off the mark is maybe, there's a sense, which I think is accurate, that there aren't really going to be any deliverables from this visit. I think that's very fair to say. But this is one of those occasions where just establishing those lines of communication, it's not sexy, but I think in this case, it really is important. We've got a new economic team in China. We've got a relationship that's badly frayed, and we've got the two largest economies in the world and a Chinese economy that's, I think, coming under some significant pressure. So I actually really think this is both a trip that's not going to produce much directly, but is quite important.
What's important to me here is the British phrase overcome by events, OBE. How close is Beijing, and particularly their leader, to being overcome by events where they have to radically change their tone with America?
I don't think that they are there yet. I don't think that they feel truly, acute pressure such to change the relationship with the U.S. I think there's a quite high bar to get there. But I do think that there are risks of accidents in the relationship. The balloon episode clearly showed that. And there are also risks of accidents on the economic side, whether that's something that happens domestically within the Chinese financial system or U.S. financial system for that matter, or that happens between the two sides when we have these pressures for decoupling or de-risking or whatever you want to call it. We've had some reminders even this week about some of those pressures. I'm, speaking here of the Chinese moves to impose export controls on some metals used in semiconductor production and potential U.S. restrictions on Chinese companies using cloud computing. So there's a lot of risk for accident, and that's why I think those channels are important. They're not going to be resolved on this trip. They're probably not going to be resolved at all. But the ability for Yellen to make contact with this team so that if they need to make a follow-up call, they know who's on the other side of the line to establish that dialogue, that I think is really important.
Michael, language is important. We hear decoupling and de-risking quite a lot. What's the key distinction between the two for you?
Honestly, neither of them are good. I think decoupling was clearly not the right framework because these two economies are not going to be separated from each other. De-risking, I think, is a little bit better, but also doesn't capture it. De-risking sounds passive. It sounds innocuous. What we're really talking about is, I think, a dynamic, and this is kind of academic speak, but I think it's really correct here, is weaponized interdependence. These are two governments that are really using supply chains, sanctions, different tools to try to achieve an edge and to try to, influence each other's behavior. So de-risking is too innocuous here to describe what's going on.
And Michael, it seems to me that they want to identify very specific parts of the economy in China that they want to stop US business doing business with. Michael, do you think that's possible to do that with a country like China?
I think it's going to be very difficult. I think the areas that are now defined by national security concerns in both countries are becoming much broader. National security is now an issue that, is moving into areas like biotech that one, normally would not associate with a national security issue. So I think it's going to be quite difficult. And I think the other challenge here is that, and this is why decoupling doesn't really make sense as a concept. Decoupling is a macro term. You can look at the fact that US-China trade, continues to rise and say decoupling is not happening. But really the story here and some of the economic risks happens at the supply chain level. It's choke points. It's, what happens if China doesn't allow, certain metals or rare earths to be exported. It is the impact that US semiconductor restrictions are happening throughout China's tech sector. So it's really not at that macro level that we need to worry. It's at those, those really intricate, complicated supply chains that, frankly, policymakers don't even fully understand.
Michael, smart, and something we've all got to work harder to understand. Michael Herson there of 22V Research. Thank you, sir. Thank you very much. TK, I think an easier question to ask is, what isn't a national security concern with regards to these two nations right now?
Yeah, I agree with that. I think it's all linked, and what I would look at, which has been underreported this summer, is the Pacific expansion of the U.S. military. The shifts here, remember, John, Trump, Clinton, Trump, the agreement, the massive bipartisan agreement to walk away from some form of trans-Pacific trade agreement. And it seems like ages
TPP.
ago. That might as well be, it might as well be 40 years ago. And now we're to the point where we're figuring out where to put the next base to look for submarines.
Do you think anyone wants to introduce that concept again? I don't see that happening in the politics at the moment.
No, I don't. Based on what I read, and particularly from Greg Villiers, who's been brilliant on it, I just don't see it coming up. With that said, I think the G7 meeting in Italy coming up here in the number of quarters is really, really
12 months from now. I think it's so important. It's so important that we attend that G7
I think
get together.
The security is so strong that...
No, it's massive. In fact, Tom, I think that might be the most significant G7 in the history of G7 summits.
Could be. Says Churchill and FDR off the coast of Newfoundland.
That big. And we'll be having a conversation about why we should be in Puglia in June 2024.
It's a daily request.
To attend that truly historic summit.
It is truly true. Thank you. I got to get back on Threads.
Live from New York, welcome to the programme this morning. Plenty of economic data coming up through the next several hours and into tomorrow, of course. Payrolls just around the corner. Jobless claims, the ADP report, and job openings coming up very shortly as well. Into all of that, your equity market a bit softer, negative on the S&P 500. We're down by 0.4%. Snapped a three-day winning streak on the S&P yesterday, taking a little bit more weight off the recent rally over the last few months. Never mind the last few months. Year to date, double-digit gains on the S&P. Just phenomenal stuff relative to pretty downbeat expectations, Tom, at the start of the year.
I got 4, 5, 6 places to go on the data screen looking at the Bloomberg Launchpad. John, I'm going to go to the 2-year yield right now. We're going to get a 5% print, 5.00 in the 2-year. We're not there yet, but we're getting there. The other data I see here, which is absolutely critical, is I'm up to 22 followers.
I can see you distracted based on
I'm
that.
distracted. You know, it's great. I mean, Brahma won't follow me. I mean,
what is a thread? Have you threaded yet?
No, I haven't threaded yet. I'm following F1 people. We've got the British Grand Prix this weekend.
Nice. Silverstone.
Have you been? Is it?
I've never been, and we should go.
Is it?
Maybe we could make it. We could fly to
Is it
London.
like different than the others? Is it like Austria where it's sort of wider but not stupid wide
Rains
like
a lot.
Miami?
It can rain a lot.
It can
Given
rain
that
a
it's
lot?
the UK. Have you seen what's been happening with Wimbledon, the tennis?
Yeah, big rain.
Lots of rain.
Yeah. Everybody there's on threads.
Typically a problem. Have they been threading
They've
as
been
well?
threading.
Nice.
Lizanne
Okay.
Saunders. Oh,
I want to get to the
she's
bond
up to
market
like 500
briefly.
threaders.
2-year yield up by a couple of basis points. When's Bratmo back? That's what everyone wants to know right now based on how this is going. 4.97 on a 2-year, 4.98 a little bit earlier, close to 5%. Remember the higher the year, higher the cycle, 5.08%. Not a million miles away, 10, 11 basis points away from that level, going into the banking malaise, coming out the other side, and we put all that yield back on top again, Tom.
Real yield coming through 1.73%. And the real yield, the 10-year inflation-adjusted yield, that matters to Lizanne Saunders with decades of experience, chief investment strategist at Charles Schwab. Lizanne, I just want to cut to the chase. How do you identify a second leg of a bull market, or do you just hope and pray? I'm looking at a summer, not of discontent, but a summer of building walls of worry. That sounds good to me for equities to go higher.
Not only good, I think it's necessary at this point, because what we had going for the market back in October was sort of the trifecta of an oversold market, technically improving breadth under the surface, even though the indexes had taken out the prior June low, and you had really washed out sentiment. Fast forward to the recent period, sentiment has gotten arguably pretty frothy, both on the attitudinal side of sentiment measures as well as the behavioral side of measures. You look at things like equity ETF inflows, 80% of them were in equities out of all ETF flows in the last month. So sentiment has gotten pretty stretched. And you rightly point out, Tom, it's not just about nominal yields, but real yields, which are up because inflation hasn't reaccelerated. And given rich valuations and multiple expansion, which has nothing to do with earnings this year, it's all multiple expansion, I think the rise in both nominal and real yields is starting to kind of take a bite out of some rich valuations.
How do you participate in equities? At the margin, do you sell shares? Do you make a dramatic move to the triple leveraged all cash fund? I mean, what do you do if you're in it? You're modestly or frankly really successful in equities the last 12 months. What's the action plan?
So I think there's 3 action plans. 2 of them are really back to traditional disciplines, but maybe with some fine tuning. So diversification, but we've been emphasizing this is when having some international diversification is to your benefit. And our bias has been a bit more on the developed international side than the EM side. Rebalancing, but a nuance there is maybe consider portfolio-based rebalancing versus, say, calendar-based rebalancing, like traditional mutual funds rebalance the last week of every quarter. Some individuals just do it once a year, or maybe a couple times a year. Let your portfolio tell you when it's time to make an adjustment, doing some, adding low, trimming high, as I like to say. And then, as you know, Tom, we've been very factor focused with kind of a quality wrapper around factors. So strong free cash flow, healthy balance sheet, self-funding companies that don't need to go to the banking system or the credit markets, positive earnings revisions, positive earnings surprise. So we think focusing on those quality-based factors with span both on the growth factor side of things and the value factor side of things is the way to approach what you're doing inside your equity allocation.
Lizanne, wonderful to hear from you as always. The conversation that Tom and I have been having over the last couple of months is just the amount of people that went into cash at the start of the year and feel trapped by it, and they've missed out on these big gains year to date. Could you just give us some insight into how conversations have been going with clients who have been in cash and maybe put in too much money into cash relative to the gains we've seen elsewhere?
So I think it really depends on the client. What we're finding is a lot of our investors that are yield-oriented investors, even with the bit of a miss on the performance upside, are perfectly comfortable locking in that 5% after years and years and years of having to go way out the risk spectrum. And then I don't need to remind you all there, John, you talk about it a lot. There's the concentration aspect. So yes, if you're an index investor and you were out of the indexes, you didn't get that cap-weighted benefit. But if you were an individual stock picker, given until very recently how much equal weight is underperformed cap weight, you would have had to be in the mega cap 8 names, because that's where the vast majority of performance has been. Whereas the other stocks, the other 492 stocks, at the end of May into the beginning of June, it was record percent of stocks were outperforming the overall S&P index over the prior 3-month period of time. So really depends on who the investor is. But yeah, you needed to be in the cap-weighted indexes to match that kind of return, unless you just were in the mega cap 8.
Lizanne, you mentioned international briefly. Could you build on that a little bit more about how people should maybe approach taking international exposure, particularly for those people that maybe haven't done it before?
Right. Well, so from the perspective of Schwab, our strategic asset allocation models, in terms of what percentages they apply across asset classes, of course, depends on whether you're on the very conservative end of the spectrum or the more aggressive end of the spectrum. And we don't pick individual countries on a regular basis, but our emphasis within developed markets has been more Japan than Europe. But because we approach it more at the big picture, developed markets versus EM, there's any number of ways to take a somewhat passive approach to get that exposure without having to pick individual countries.
Where is the value that's not a value trap on a sector basis? I think I want to talk about energy, but tell me I'm wrong. And there's another sector that is an opportunity rather than a trap.
Well, energy, I'm glad you mentioned that, because it's generically considered value, but because of the massive earnings growth, not this year, but last year and even in the year prior, remember that S&P does the rebalancing of their growth and value funds in December versus Russell's, which just happened last week. What happened with S&P's pure growth index, December 18th, the day before rebalancing, pure growth was 37% tech and had all 8 of the mega cap 8. On December 19th, S&P pure growth was 13% tech, and energy was the largest weight within pure growth. And only 1 of the mega cap 8 was still in pure growth. So energy was a growth area last year in terms of the fundamentals of earnings growth. We generically think of it as value, but last year it was the only sector that was up. It was mostly in the value indexes until the end of the year, and then it moved into pure growth. So I think you want to focus less on monolithic sector calls or even style like growth value calls, but don't put blinders on to sectors. There's a way to look for value, screen for value, and apply it to growth sectors, because there's value within those sectors, and there's often growth within the sectors we generically think of as value sectors. So you've got to be more open and think about growth and value as characteristics more so than index labels.
Help me with everyone that is in passive land. It has been just a great ride for passive, I'm going to say over 10 years, maybe coming out of 2009. Just at Schwab in general, do I want a less R-squared non-passive approach, or do I want to stay on a passive, whether it's SPX or it's something more narrow?
We're not or folks when it comes to passive versus active. We're and. We think there's a home for both. And it's also a function of who you are as an investor. Are you purely just looking to match some particular index? We do think, so last year active did better than, or active had I think best year since 2005 in terms of percentage of active managers outperforming their benchmark. Equal weight did very well last year. Correlations are now coming down. I wouldn't be surprised if equal weight starts to reemerge again relative to cap weight, and that is to the benefit of active. That doesn't mean active is going to leapfrog passive. It just means that active may, like last year, have a more level playing field on which to compete relative to passive. But it's really the individual's choice for a variety of reasons.
It's just fascinating to me, Lizanne, where we are. And I just really want to harken back. You're too young to remember this, but there was a big lift in 75 or 76. Zeppelin was out. I think it was on the West Coast. And Lizanne, all of a sudden there was a second leg to a bull market, which at the time, I remember this clearly, no one saw coming. Are we there now?
I think too soon to tell. You're right to point out 75, but that was the beginning of a cyclical bull market. It was an ongoing secular bear market that didn't end until the early 80s. Interestingly, 1975 and 1983 were the 2 years where the performance of the NASDAQ in the first half was stronger than what we saw. This was the third best first half. Now, you were at the beginning of cyclical bull market in 1975. That meant, though, you still had some more upside, but unfortunately, you had a significant amount of downside. 83, different story, because you were in the beginning of a secular bull market. But in both of those cases, the first half strength gave way to second half weakness. It was more what happened beyond that was defined by the secular nature of the environment that we're in. I don't think we're in a secular bear market. I think what we had, both with the COVID bear market as well as the bear market last year, assuming it's over, I think we're, let's hope anyway, cyclical bear markets in an ongoing secular bull. But I think we're in some sort of tricky state where it's hard to figure out what, say, the next 10 years looks like.
Lizanne, Clinic, as always. Lizanne Saunders there of Charles Schwab. Lizanne, thank you. Thank you very much for joining us on the equity market. The surprise of the year, Tom, just the performance we've seen in stocks relative to the gloom to start 2023.
Well, you go to stocks, but you got to go to other places as well. And that's why this, it's like July, what was it, 98 degrees yesterday? I mean, it was like crushingly hot. It was like sort of hot like an Italian island, but with humidity. And the answer is, John, there's a lot going on here into these 2 days of economic data coming up in less than 2 hours. I'm going to go to the 10-year real yield, 1.7344. I like what Kit Juke says, and he calls it big figuritis. I've never heard that phrase. It's brilliant from the gentleman at SocGen. Big figuritis is what you're going to have to pay at the tots to keep Harry Kane. Also, big figuritis, 4% this, 5% 2 year. And I'm going to take it over to foreign exchange. I'm sorry, 16.99 on dollar MEX is a big figure. That's a shock to people. Stephen Englander's got to look at that and go, what happened?
It's amazing how much you managed to fit in there. Digs about my vacation, squeezed in Tottenham as well.
It's a skill. It's
Sprinkle
a rare
of
skill.
A little bit on Kit Jukes and SocGen and the bond market.
Arsenal tots, September 23.
You'd like to go to that,
Jukes,
wouldn't you?
He's got like 6 season tickets.
Kit's got 2 season tickets,
Leave the kids at home and he can take you.
I've attended a game with Kit before. Would you like to attend that game? Yes. We've been to the Emirates together many years ago.
I was going to call up my good friends at the tots and say,
In fact, I believe Kit and I actually watched the North London derby together. We watched Arsenal versus Tottenham.
We did not.
Arsenal crushed Tottenham.
I was at the Lanesboro having a cigar. Everybody.
Can I get to the quote from Kit?
Everyone that works at the Lanesboro cigar bar supports Arsenal. They all.
I've not
everybody
missed
supports this.
I've not missed this.
Good, thank you.
At all. Kit talks about the market reaction to Fed minutes yesterday, to sell the longer end of the curve, to sell equities. He said 10s are getting closer to 4%, and big figuritis may demand that risk sentiment takes a hit when that level breaks. We're pretty close to it right now. The 10-year, 3.98. Andrew Holdenhorst, the City, coming up a little bit later this morning. We'll catch up with him at 8:15 Eastern Time. That's about an hour and 30 minutes from now. From New York, this is Bloomberg.
We do see some storm clouds on the horizon. We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates. I wouldn't chase this rally too much. I would stick to your plan, stick to your asset allocation, rather than moving things around one way or the other.
You know that Spider-Man meme? You ever seen that before? Where it's two Spider-Man and they're doing that to each other. You ever seen that meme before? You must know that meme.
No.
Mark Zuckerberg posted that meme on Twitter. You know, you've never seen that meme?
No.
The two Spider-Men, they point at
I
each
haven't
other.
even seen the Spider-Man movies.
Okay, all right.
You know.
Well, Threads, I have
see
to
the
say, you know, this
Flash,
is it.
but
We can put it up on the screen. Take a look at this. You must know this meme.
No.
You don't know that? Come on.
No, I don't know that.
Anyway, basically, Threads looks a lot like Twitter. Wouldn't you agree?
Okay.
Based on my experience with that app overnight, feels the same.
On this? These two guys, they're really rich and all that. Would they just buy, like 7 medical educations in America? Pick the city.
Don't you think some of them are doing some of that anyway? I'm sure they are.
I don't know. I think it's all sort of like, step up and really do something substantial for pick the city.
You're saying Threads isn't it?
No, it's fascinating. I mean, I'm really looking forward to this conversation we're having. How are you doing with Threads? Are you verified yet?
No, I'm not verified. In fact, I'm doing terribly.
Piastri is verified.
I had the Ferro TV handle on Instagram, but always kept it private and never developed a following.
And you have that on Threads?
So I have that on Threads.
Oh, wonderful.
So what have I got? I couldn't port any followers because I didn't have any. So I've got 4 on Threads. So this is going really, really well. This is going really well. Rockstar status.
Bramo and the tribe following you.
Over on Threads. Nice. Thank you to those 4 followers. It means a lot. I will never forget you.
Let's talk about this build-out. This is going to be really, really interesting. We're really pausing this. John and I usually ignore this stuff, but this day seems different. Alex Webb is with us with Bloomberg Quick Take. He looks at this stuff 24/7. Is this day different, Alex Webb?
It does feel like they've really gained traction very quickly. Let's say the most recent numbers we know, in excess of 10 million users. I know because it puts in my profile, I was the 10,300,000 and something thousandth user. So there are a lot of people out there adapting it. That is faster than almost any app we've seen launched that I can recall. They talked about ChatGPT having a record launch, and that was 1 million users within a week. The challenge is that as a total percentage of Meta's user base, which is in the order of 2 billion, it's less than 1% of that. So is it going to be damaging to Twitter? Potentially. Does it really help Meta? At this stage, not yet. That doesn't mean there's a path to that happening.
Instagram is different than Twitter. Will Threads be different, or do they just copy what Mr. Dorsey and then Mr. Musk have done?
It pretty much looks like it's an almost clone of Twitter. There are some differences. You don't at this stage have the ability to only have in your feed the accounts that you follow. It is feeding other stuff in there, much in the way that TikTok does and increasingly Instagram does. It doesn't yet have a desktop version. I suspect that might be kind of a big deal, given that so many of the sort of turbo users, the people who generate a disproportionate amount of the content, often do so from desktop platforms such as TweetDeck. That doesn't mean, though, that these functions won't come. There's a suspicion that Facebook or Meta accelerated the introduction of this to capitalize on some of the problems we've seen at Twitter, for instance, in the past week, capping the number of tweets you could see to restrict the load on servers.
Alex, as you know, Twitter over the years has had many CEOs over the last decade or so. It's never been a phenomenal business. I'm just wondering, Alex, what Meta can do with its version of Twitter that various people haven't been able to do with the actual platform.
Ads. Like Twitter has not had a really effective advertising machine. That is Meta's real core competency. They have a very well-oiled machine, close relationships with big brands. Brands see their platforms as a safer space to be than Twitter. Twitter, you've never really sacrificed that much of your personal data to it. You didn't have to and able to use it. So a lot of it was sort of contextual. They could sort of infer from the accounts that you followed what things you're interested in. Meta has far better data on you already, given that in order to have a Threads account, you've got to be porting it from an Instagram account. That means they can do better targeted advertising, even with some of the controls imposed by GDPR and similar legislation, CCPA in California, for instance. So they have, if they can pump their existing ads infrastructure into Threads, they have the potential for a lot more upside than you currently see at Twitter.
Alex, we're having this conversation here in the United States. You're having it in London, I believe. It's not a conversation that you can really have on the continent within the EU. Alex, what's happening with that, and why was that an important decision to make?
So there is a new set of legislation in Europe which essentially restricts the ability for companies to port data between different services. It's something that regulators in this part of the world really don't like. When you leverage strength, or I should say in that part of the world, they leverage strength in one business in order to generate strength in another. It's the sort of thing that Google and others have been fined considerable amounts for over the years. This is exactly what this business is, right? You're taking your Instagram user base and porting them over to this new app. Therefore, in order to obey the letter of the law, or at least see whether they could find a way to make it work, it seems that they are not offering at this stage threads in the European Union in order to reduce any sort of legal vulnerability that might emerge from it.
You think that will change, Alex, eventually?
I suspect they'll find some sort of workaround. I mean, it seems ultimately at some stage threads you should be able to sign up to it without an Instagram account. You can see why they haven't done that to begin with, partly because it means you have a pre-formed social network, a social graph where I open the app and I'm already engaging with people that I know from other platforms without a huge amount of legwork. That would seem to be the obvious fix to it. As we know, as we were saying, this has kind of been developed on an accelerated timeline. So, in the fullness of time, you can see that they will maybe do that.
Alex, without doing fancy differential equations or Ethernet functions or power functions, blah, 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 how do you get to critical mass? And where does Alex Webb think threads where do you guess the timeline is to where they get to so-called critical mass?
Look, I think they need to be as big as Twitter, which is sort of 300 million users. That's when I think it starts to become meaningful for Meta. They have 2 billion users across their various apps. I think Instagram has about 1.5 billion. Those are incredibly valuable users because they're often in that super attractive 18 to 35 demographic. I don't know how long it's going to take them to get to that point. 10 million is a great number out the gate. I suspect they're not going to be adding 10 million a day for the next 30 days, right? That will be a huge ask. It took Twitter 15 years to get to that point. Nonetheless, it is an incredibly impressive start. And, the reaction in the share price, I think, is a good gauge for how people are seeing it. At the moment in the pre-market, I can see it's up like 1.5%. So, it's not gangbuster numbers on that basis, but positivity.
You do wonder how Twitter would be trading this morning if it was a public company after that unveiling last night. I've got to finish with this one, Alex. Would you expect there to be a change in approach to the way this company's been managed, Twitter specifically and Elon Musk, given what we've seen develop in the last 24 hours?
I mean, look, that ultimately gets back to this question we long ask ourselves: what's Elon going to do? Goodness only knows. In any typical company, you would expect there to be a reaction, a retrenchment, perhaps a return to some of the fundamentals with Twitter. But, Elon doesn't necessarily operate companies in the way that plenty of other people do. The new CEO, seems basically her job is to forge stronger relationships with advertisers. Is she able then to say, look, advertisers want this, therefore we should do this? That's a big question. And, there are probably only 2 or 3 people who know the answer, 2 of which are Elon Musk and Linda Yaccarino.
Alex Webb, thank you, sir. Bloomberg's very own on the latest development. Meta, Instagram, unveiling its Twitter app killer, potentially, Tom, overnight.
Fascinating. I remember when Pinterest came out, and everybody was all gaga on Pinterest.
Never used it. And Still don't know what it's for.
Some manager came to me and said, sign up for Pinterest and tell us what you think. So I did it.
And what did you think?
It never got to critical mass with me, and critically with a lot of other people.
Did it get to it with anyone?
It was it was very good for wedding planning or divorce planning or that.
People plan their divorces on Pinterest.
But, there's a value to Pinterest, but is that critical mass like Twitter, like Facebook, the rest of the big ones?
Right.
And I'm absolutely, and you asked the right question. What will be Mr. Musk's response to what we are witnessing, say, in 48 hours?
It's been a haphazard approach to the platform. Yeah. He has treated it like a startup, at least from many people's perspective, over the last few months. Be interested to see, Tom, how seriously he takes this. And again, I do wonder where Twitter would be trading if it was a public company this morning. I imagine it would be down in the pre-market, based on what we've seen.
I don't know. Fascinating. Alex is very valuable. We should have him on more often.
We should. How often would you like him on?
When I get up to 100 followers on Threads. I'm not there yet.
That could be this morning. Mikey Settles, thank you. Add on Threads, 19th Threads follower, but #1 fan. Appreciate the love.
God, it's just
to 19. This is big time stuff.
Large.
Big time. Emily Rowland, John Hancock. Up next.
the dip and rip hasn't happened. It's been more sort of rip.
You know, it's an interesting time because no one expected what happened in the first half.
What's important is what's really dragging up the market and how much more can that go.
You have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
I wouldn't chase this rally too much. I would stick to your plans.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market just a little bit softer this morning, negative 0.4%. Going into payrolls on Friday, into jobless claims later this morning. Some services data as well a little bit later. Bear in mind the weakness we saw in China. Let's see if that's captured by the index here in the United States too. Before we get to all of that, Tom, need to talk about the bond market that's in front of us right now. Your 2-year, 4.97, yields higher by 2 or 3 basis points this morning.
All sorts of bond indicators where we are on the watch, and this economic data could really shift as well. Michael McKee says look at the JOLTS data as one measure of the labor linkage into the spirit of the economy. I'm going to go to the 10-year real yield, 1.73%. That's a jump condition. We're buttressed right up against new highs. And the 10-year real yield, Liz Ann Saunders saying that it has a lot of value versus the nominal yield. It's the inflation-adjusted yield. But I'm sorry, you got to look at the level. And as we mentioned in the last hour, Kit Jukes is on the big figuritis watch.
Well, let's talk about levels in the UK. 540 on a UK 2-year, 540, and a real conversation. First thing I looked at when I woke up this morning, there's a real conversation in London at the moment about the prospect of going through 6 on bank rate at the Bank of England and maybe having a look at 650.
The entire arc of this, in fact, I was going through my photos. I'm trying to get verified on Threads, and I had to go back and get some proof of who I am. And the dog's the same thing, vet bill and kennel fee. And the basic idea, John, is I ran across our Jackson Hole photos from August, 10 months ago as well. This is a different Jackson Hole. This is going to be a different confab in England about how do you rationalize society, part of England flat on its back, and part of England, I think that it's like it doesn't exist. It's like good that rates are going
We've
up almost.
reflected on what happened in the Jackson Hole Symposium of 2022 at the end of August, where Chairman Powell talked about the need for pain, and if we didn't get that pain, it would be much more painful. You certainly don't see it at the aggregate level with unemployment expected to drop again tomorrow. They've been forecasting a break of 4, approaching 4.5% on unemployment by the end of the year, Tom, and right now we're closer to 3.5%. than 4.5.
And I got Ed Hyman yesterday saying he's never seen economic data like this. He's never been as cautious as he is now. And it leads to almost a courage thing, as we mentioned with Liz Ann Saunders. Which walls of worry do you want to climb right now? The walls are developing fast.
These surprises have been positive, not negative. And you can take a look at the various surprise indexes, whether it's the US or the UK. So that's data coming in relative to expectations. And Tom, it's the most positive it's been here stateside since 2021. We've just had a series of upside surprises in the economic data. We often give a shout out to Neil Dutta of Renaissance Macro. Let's give him another one. He's been talking about the home builders now for the best part of the last 12 months. Yeah. The home builders year to date are up by more than 40%. And Tom, never mind the recession debate. There is a conversation happening in parts of Wall Street about the prospect of things not only being better than expected, but maybe even improving in certain parts of this economy too.
The core Neil Dutta theme, folks, and this is really important. If you look at a labor economics textbook, you think you're going to get an A, and then about chapter 2, you realize you'll be lucky to get a quality C. One of the things Dutta's optimism comes from is you have wage growth and inflation comes down, so your inflation-adjusted wage improves. And Neil's very, very big on that being an understated idea, going from 2% economic growth in Q1 to wherever we are right now.
Real income's getting better. Futures right now on the S&P, negative 0.4%, just a touch softer there, going into data in about an hour and 25 minutes from now. Then on to payrolls tomorrow. If you're interested in the median estimate in our survey here at Bloomberg, those numbers still coming through. 225 is the estimate at the moment for tomorrow morning, relative to the number we had in the previous month, Tom, of 339. You'll get a appetizer. We call it the appetizer for payrolls a little bit later, the EDP report. That's expected also to come in at 225. That's the estimate at the moment. The previous number, of course, 278.
Those are important numbers, but average hourly earnings, I'm going to look at it, and McKeith says to focus on JOLTS as well. I'm just going to focus on the wall of Bloomberg data we have. It's a huge advantage Bloomberg has here. John, you mentioned UK rates. Can we talk about German 2-year? I think Germany's like flat on its back is a fancy way of putting it.
Recession. From
0% negative interest rates January of last year. They pop up, they get to March, and now they're right up ready to break through the new March highs. And that's in Germany, flat on their back.
Let's get to Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. Emily, wonderful to hear from you, as always. Tom and I were just talking about it. You've got some people on Wall Street forecasting recession, other people saying things are set to improve. Where are you in the team?
Yeah, this is a very, very tricky late cycle environment where things often look pretty great right before they're not. And you had the great Ed Hyman on yesterday, talking about this, how this late cycle environment's lasting a long time. And we would define that as a period in between when the leading economic indicators go negative and through the recession. And that typically only lasts about 6 months, but we're on month 10, 11. And in the 06-07 example, we went to 18 months there. So these are periods where you're seeing a lot of chop in the economic data, a lot of chop in yields. You want to participate in the market because risk assets can see these big swings higher. But you guys were talking about I think it was the European Grand Prix earlier on the show, and it got me thinking about how you want to participate in this market. And it's sort of like drafting in car racing. You don't necessarily want to be out front here, taking on too much risk. You want to participate by owning things like higher quality assets and leading into bonds.
I mean, I look, Emily, at where we are in the zeitgeist, just buy quality, buy persistent free cash flow. I get all that. I just want to know, do I want to be in the market or not, given the way my head's spinning with the data? Are you participating in equities?
Yeah, you definitely want to be there right now. As I said before, you can see these massive swings higher in risk assets. As you almost see investors celebrating, as John mentioned earlier, this idea that the economic data have come in a lot better than expected in many cases. So you also want to think about this kind of almost pivot party that's going on right now as investors celebrate the idea that the Fed is getting to the end of its tightening cycle. We've only got one more rate hike priced in, then a hold, then cuts in 2024. So the pivot party can be a pretty powerful one. You want to go to it, but you might want to think about, sipping on a light beer instead of reaching for the tequila, because you might have, sort of fewer regrets the next day.
That's CFA level 4, John, there.
Have you ever reached for the light beer instead of the tequila?
Light beer. John, I was weaned on Coors. You and young Roland don't know what Coors 3-2 beer is. The only one that knows that we talked to is David Malpass.
Talk to me about Coors 3-2 beer.
David Malpass had a keg of Coors 3-2 beer in his room at Colorado College years ago. It was some moralistic Midwest evangelical thing. I don't know and this is all before light beer. And so you were too young. You were getting shot in Vietnam, but you were too young to have a Bud. So you had a Coors 3-2 beer, which is, think of it like a Coors Light.
Right.
Put a glass of water in it. And that's
even worse than
beer.
A Coors Light.
Oh yeah.
Even worse than that.
Malpass had a keg of Coors 3-2 beer in his room at Colorado. That's how he got through physics.
How do you think Bud sales did over the July 4th holiday?
Actually, it's a really reportable issue. It's maybe not what we do early morning, but I think in terms of marketing and advertising, the debacle at Bud Light really needs to be studied by every institution.
Look at what you started, Emily. Let's move on from that.
Guys.
Talk to me about stocks that you do like, sectors you do like right now, and sectors you want to avoid.
Yeah, so we continue to lean into quality. That's companies with great balance sheets, lots of cash, a limited need to tap the capital markets in order to grow. That does lead us to the technology sector. It leads us to the U.S., which, of course, has an abundance of technology stocks compared to the rest of the world. So, we do recognize that tech, of course, has run a lot. We started to see that market leadership broaden. We're worried about valuation risk as well. So we want to look to parts of the market that can help protect portfolios from that. Mid-cap stocks in the U.S., mid-cap value in particular, one of the only areas that's trading at a discount, not only to its own large-cap peers, but also to its own history. That's another area that we're looking at in portfolios to diversify. And again, leaning into bonds, you're getting 5% on high quality bonds right now, investment grade corporate bonds up in the credit spectrum. That's another place we think that there's a great mix between risk and return.
If I remember correctly, Emily, and correct me if I'm wrong, you didn't jump on the international bandwagon in the way others did at the start of the year. Emily, why was that?
Well, I think that there's an idea out there that there's going to be this immaculate economic cycle where, somehow potentially the U.S. goes into a recession, but the rest of the world avoids one. And that's just never been the case. And we continue to believe that we're going to see a global economic recession. You just look at the PMIs on the manufacturing side. Germany's at 42, and meanwhile, you're seeing European equities at all-time highs. To us, the macroeconomic backdrop just simply doesn't match with a cross-asset performance. And also, when you think about owning European equities, it's very cyclical, high beta. They tend to do better early in an economic cycle. And right now, we think we're in a late cycle environment. So we think that you want to wait. We do have some of it in portfolios. We're overweight Europe versus emerging market equities, but we think that the better time for Europe is going to be in the future.
Emily, wonderful to hear from you, as always. Emily Rowland of John Hancock Investment Management on booze, sport, and a bit of markets.
She covered it all there. F1
Does it get
chat?
better than that? Bit of F1 chat too.
Yeah, I had no clue, but
told us coming into the segment in the commercial break, very excited about Wimbledon.
I don't know. She was talking about draft in the F1, and I thought it was Amstel Light. The answer is like NASCAR, there's big draft because they're big cars, but the F1 cars are so low, they don't have the same. Like when Sainz of Ferrari gets behind Leclerc.
You get the slipstream.
He gets a little bit of, he gets a little bit of a, like tenths of a second toe, it's
then
called.
You pop out, and then you
call
get
it
that.
toe.
You press that DRS button,
and the
drag
guy,
reduction system, and
very seriously,
feels like a cheat mode.
Here.
I don't like it. I'm not a big fan.
And yeah, the DRS thing.
Yeah,
get rid of it. I'm the same way. But to your conversation with Christian Horner, I think it's been way underplayed. This guy Verstappen is like Ohtani with the Los Angeles Angels.
What Max did over
it's
the weekend.
Unreal.
What Max did over the weekend to come in on the last lap. Just before the last lap and make a pit stop just to put fresh tyres on and get the quickest lap to get a single point.
And we're not going to commercial. This is too important. And what's important here is Sky TV, with their great coverage, love what they do. They ignore him because he's so far out front. No one in American sports would do that. But Sky TV just ignores him.
Yeah, but that's the F1 director. I'm not a big fan of that. That's come off the back of the Netflix series that they start to look at these races at the back of the grid.
Oh, is that from Netflix?
Yeah, I
don't know that.
I'm not interested in that.
Yeah.
If you are just tuning in, welcome to the program from New York City this morning. Good
F1
morning.
today.
Equities this morning down about 0.4%. Coming up in about 48 minutes from now, actually, at about 8 a.m. Eastern time, we'll catch up with Dom Constant of Mizuho Americas. TK, I know you get excited about catching up with Dom. We'll do that a little bit later this morning.
This guy is fabulous. He owned the high ground at Credit Suisse years ago. Ira Jersey and others just put out a definitive linkage of the economic system into what fixed income said. I'm fascinated with what his update is here, because so much of where we are now is where he said we were, and he invented this phrase, super restrictive. Are we super restrictive now?
And never mind super restrictive. Are we sufficiently restrictive? Tom, how about this one? If I told you at the start of the year precisely where interest rates would be in July of this year, on a 2-year at 4.97, if I told you with precision where that would that help you make your equity call?
No, because as Emily Rowland just brilliantly said, Germany's flat on its back, and German equities
there you go. There you go.
Yeah, I don't.
It's always the tough one. You can make the macro call, you can make the rates call, and then even if you have all of that information precisely in hand, sometimes you still get the equity call wrong.
You got to buy companies, but in this environment, what's on the screen, my choice set is so small. There's so few companies that get it going.
Janet Yellen, the Treasury Secretary,
nailed that.
Touching down in Beijing. It's been a while, TK. Let me warm up. Just give me a couple of days. Be nice. We're meant to be friends.
Okay.
Jeanette Lowe of Strategas on Yellen's trip to China. Up next.
Just establishing those lines of communication, it's not sexy, but I think in this case, it really is important. We've got a new economic team in China. We've got a relationship that's badly frayed, and we've got the two largest economies in the world and a Chinese economy that's, I think, coming under some significant pressure. This is both a trip that's not going to produce much directly, but is quite important.
Valuable conversation this morning with Michael Herson there, the head of China research at 22V Research, as Janet Yellen, the Treasury Secretary, touches down in Beijing to meet with her counterparts in the Chinese government. The second high-profile trip that a cabinet member has made, Tom, in the last couple of months. Secretary Blinken, of course, first, and then Secretary Yellen follows. The
zeitgeist here is nothing's going to get done. You make an appearance, you go through the motions, and that's a good and beautiful thing always. I would just go to renminbi, 7.23 yuan per dollar. John, this is a devaluation of the Chinese currency. You can rationalize it however you want, but I would watch that, and as she comes back to the United States, if China struggles and you see yuan break down further, I don't think it's the same as it was 6 months ago. It's a big deal.
Well, let's be clear here. We used to talk about deliberate manipulation of the currency, Tom, to weaken it. And that word devaluation is quite loaded. Is this a depreciation off the back of weak data in the mainland? Or is it something else?
No, it's a nuance here between the word devaluation and depreciation. You're absolutely dead on, and that maybe it's not as fixed in devaluing as it was before, but nevertheless, it could be a depreciation off of a struggling economy. To be clear, while you were gone, Leland Miller he was absolutely clear. Leland said, this is baloney. China's doing better than we think.
How many digs is that this morning about not being here?
I don't know.
It's 7:18 Eastern time. We're about an hour and 20 minutes into this. How many is that?
I can't count. It's
take a vacation.
You got more followers of threads than I do.
How many have you got?
I don't.
Have a check. See what you got.
It's like
it's pathetic. See what we got.
Yes, it is.
This is pathetic.
That's what our head of social says.
28.
It's pathetic.
What have you got?
Tom, can we help you? Can we help you over a cup of coffee with threads? I don't even know how to get to my 25.
Oh, nice. I'm 25. Beating you. All right, let's
excuse
stop
me.
the game.
75.
No, for goodness sake.
Large.
We're not playing anymore. All right. The market looks like this. Futures negative 0.4% on the S&P. In the bond market, deep down I'm unhappy about that. In the bond market, yields higher by a couple of basis points.
Sam Rowe put me over the top.
Sam Rowe didn't follow me. Let's sort that out. 2-year, 4.97 on a 10-year right now, Tom. 3.97, getting closer to those round figures of 5% and 4% respectively on the curve. 2-year versus 10-year, let's call it negative 100 basis points right now.
It's a holiday shortened work week, but guess what? The next 2 days really matter here, an hour and 15 minutes away from a slew of economic data. And then there's policy in Washington as well. Jeanette Lowe briefs now, Managing Director, Policy Research for Jason Trennert at Strategas. It is a Baird company. Jeanette, thank you so much for joining us. I want to move forward. Secretary Yellen comes home. The zeitgeist is clearly not much is going to be done. Then what? In August, in September, in January of next year, how do we amend our relationship with Beijing?
It's a great question, and thank you for having me. So I think that Yellen is going to China to try to reset relationships, which I think that's everyone's understanding. She's trying to kind of tone down the rhetoric that we have seen over the past couple of months. We've had some issues with planes coming close to each other, ships coming close to each other in the South China Sea. She's really trying to tone down the rhetoric, make this less about decoupling and more about de-risking between the U.S. and China. And so part of that is to kind of keep the negotiation points open. There is new teams in China, so she is trying to build up new relationships there and just start to have more conversations as we don't even have military to military conversations currently. But I think going forward, the biggest thing is that this trajectory is not going to change. So the U.S. and China are on a trajectory to have the U.S. continue to de-risk in key sectors, and we're going to continue to push our allies to do so at the same. Next week, you're going to have the House come back from recess. They're going to be debating the National Defense Authorization Act, and they already have some amendments that they're going to be talking about putting on outbound investment controls from U.S. investment into China.
I mean, Jeanette, while you're talking here and on Bloomberg Radio, we're showing videos of everybody smiling, grinning. Let me take the side of the conservatives and, frankly, some Democrats as well, the liberals and conservatives in Congress. I'm going to pick on Marco Rubio of Florida as someone who doesn't trust this. The Chinese are doing the smile, meet and greet thing. What do they want from us?
So they definitely would like us to stop the tech restrictions that we continue to put into place on semiconductors, because that is definitely putting a bit of a hamper on their development of these key technologies that they believe is important for them to have a greater dominance within the world. So that is something that they are going to be looking. I think the fact that they announced having, 2 critical minerals, having some export controls on those on Monday, that is kind of, people are calling it a bargaining chip, and it is kind of a way for them to say, we have ways to retaliate as well against you if you're going to do these things to us. So it may be a way for them to try to get some concessions, but I don't really see much concessions coming down the road. The US is definitely continuing to move down this path. Yes, we might be watering down things as we go, but we continue to add pieces every couple of months. Obviously, we started this last October with export controls. We're going to continue to do so. The president is still expected to put out an outbound investment, kind of a reverse CFIUS process to review U.S. investments into China, potentially this month, potentially at some point this year. You also have the talk about U.S. trying to now block Chinese companies from using U.S. cloud services so they don't get around the semiconductor issue. So that's another thing that is still on the table. So I think we're just going to continue to add pieces, but at the same time, the U.S. and China do need to talk.
Jeanette, we're hiding behind a phrase, national security. Jeanette, Tom and I were talking about this earlier this morning. What isn't a national security issue right now with regards to the relationship between these two nations?
It's a great point, because I think that now the U.S. is starting to take a much bigger view of this. We're looking at things like farmland now much more closely than we would just about, what is in our missiles and what do we need for certain ammunition or things like that. So the definition is definitely getting broader. It was also interesting that China also used the national security line when they announced those export controls on Monday. So now everyone's going to be able to use this as their argument going forward. Definitely makes things a lot more difficult. We're definitely moving into a new environment, which is much more about deglobalization than globalization. And so it's going to be a lot more difficult to kind of parse the free trade that we've normally been seeing amongst countries if this is the new dynamic that we see.
Do you see Europe still sitting on the fence?
I think we've definitely seen Europe move more and more towards the U.S. direction. I think the fact that the U.S. did get Japan and the Netherlands to agree to do these export controls on semiconductor equipment was quite important. And I think that you are seeing Europe, while it wants to move a little bit more cautiously, it is definitely more in the camp of seeing the risk with China, similar to what they saw with Russia and the war in Ukraine and having too much reliance on Russia. I think that is becoming more and more clear. It's just how do they go about doing it, especially when they have so many members that they have to kind of, deal with consensus there.
Important trip for Secretary Yellen. Jeanette, we've got to leave it there. Thank you. Jeanette Lowe there of Stratega. Secretary Yellen, Janet Yellen, touching down in Beijing just several hours ago, Tom, to kick off a series of meetings with their counterparts. It's
going to be serious. I wonder if she's opened up her Threads account while she's in Beijing. But, I'm sorry, it's serious. And to take the side of the China critics, what is this diplomacy signal? Shake hands, smile, smile. And I guess, Henry Paulson would tell me, well, you're just doing it. You're showing face and you're there. But what's actually going to get accomplished? I'm trying to follow people on Threads. I'm trying to follow Anne-Marie Horder.
You're very distracted. How's that working out?
It's like really clumsy.
AMH is a big hit on Instagram, so she can port loads of followers over to Threads.
Are you on Instagram?
Not really.
Yeah,
I have the handle. But I've never posted a thing on there.
Yeah, either have I, and I had to sign up today to do it. It's like stressful.
Never been. I struggle with this, Tom. I'm conflicted. I've never been a Zuck fan. Fan of Meta.
I
and
agree.
All things Meta. It just feels a little bit,
Totally agree.
Anyway,
we're both like squirming. Where's Bramo?
Just a bit.
She's a monster.
You going to do any work this morning?
No, I'm doing the same.
Fancy it.
I'm trying to figure out a trade here with Mark McCormick. We'll get to that in a moment. Other than I'm doing Threads.
Nice. All right. You've worked that out. Futures right now. Welcome to the
McKee's
program.
in charge.
Just a little softer on the equity side of things. We're negative 0.4% on the Nasdaq. We're down by 0.4% as well. Small caps underperformance over the last 24 hours. Underperformance again this morning. We're down by 0.6% on the equity side of things.
I'm looking, John, here at the economic data. I think we've undersold it. I've been guilty of this. An hour from now, we begin 48 hours, actually 25 hours, of absolute crushed insanity before the Fed meeting in July. McKee says follow JOLTS, but, there's a whole bunch of things to follow here.
So let's go through it. 45 minutes from now, the ADP report, the appetizer for the big one tomorrow morning, payrolls. The expectation, the estimate in our survey, 225,000, the previous number 278.
Terrible recession level.
After the ADP report, you'll get jobless claims 1 hour from now. Jobless claims looking for a tick higher there, 245 up from 239 in the previous read. Then you get job openings, looking for that potentially to break 10 million. We'll see. And then an important one a little bit later as well, at the same time that you get JOLTS. ISM services. So a read on the services sector in the United States of America. We know what manufacturing's doing. Not great things. Let's see, Tom, if that corresponds with the services read a little bit later this morning.
I have to see. That's the economic data. And as well as that, we've got a lot else going in. John, let's tilt to foreign exchange right now and do a review. DXY just fractionally under a 103. Maybe somewhat of a give back. The Bloomberg Dollar Index, which is much more EM at 1231. Fractional. I know the Bloomberg Financial Conditions Index is more accommodative. That's not what Powell wants. Maybe the market's out front of that as well.
You mentioned the FX market, the euro right now, just short of 109. High of the session, 108.96. Right now, 108.94. We're positive on that currency pair by let's call it 0.4% on the euro against the dollar. As investors weigh the Fed's options at the July meeting, Mark McCormick of TD Securities calls for another pause, writing this: for US, disinflation is the main driver and sending the strongest directional second half cue for the dollar. Our outer consensus call that US disinflation is strong enough for the Fed to skip July, effectively ending the cycle, would reinforce lower macro volatility, Tom, late cycle growth dynamics, and boost carry.
Right now, a clinic. We are thrilled to have Mark McCormick with us, Global Head of FX and EM Strategy at TD Securities. And Mark, I got like 8 ways to go here, but the only way to go is for you to define what carry is for mere mortals. George Saravelis, your good competitor at Deutsche Bank, his entire essay this morning was on carry, and particularly Asian carry. Right. That's Greek to our audience. Okay. Define a carry trade right now.
So carry trade is the way of looking at the dispersion, the gap between interest rate differentials between higher yielding currencies, which are particularly in emerging markets, Latin America, Eastern Europe, versus low yielding currencies, which are basically in Asia and parts of Europe. So what you're doing is you're funding out of the lower yielding currencies into the higher yielding currencies. But the most important component of the carry trade is volatility. So what we do is we look at interest rate differentials and we adjust them based on volatility. And then essentially our carry model looks for the appropriate basket to trade that based on the dynamics of interest rate differentials and volatility.
It's a field day now in carry. What does it signal that there's such an imbalance in global FX?
Well, the big thing is the hiking cycle started in emerging markets. They needed to basically get the credibility. They were ahead of the curve. It's kind of the first one in, first one out concept here when you think about EM, because everyone feels very confident that LATAM and other central banks are going to cut in the second half of the year. Whether or not you see that in the G10, that's very different. But I think the main thing here is that in these parts of the world, we're seeing the greatest dispersion in interest rate differentials. We're actually seeing very good growth developments. And the places where you're funding are also parts of the world where there's disinflation. If you look at where people are easing policy, it's in China, it's in Asia. So what you're doing, a lot of people we're seeing in the FX market is you're funding out of a currency like China and you're buying a currency like India or Brazil or Mexico, higher quality EM currencies, where also, particularly with India, is a place where equities have done quite well in the second quarter.
So at the epicenter of this call is a call on the Federal Reserve. We read out that quote there about Fed policy. Can you tell me, is that an expectation of what you think will happen or what you think should happen?
So what we thought should happen was they should have hiked in June. So what we think is if there's a data dependence narrative that the data was strong enough and it was robust enough for them to have hiked in June, which I think is part of the context of the minutes, which is there was an active discussion about the lags and the impacts of policy. And there was enough there to say that, yeah, we could have went. Our view is that our inflation forecast is strong enough on the downside in disinflationary terms that they don't need to hike again. I understand it's out of consensus and after the minutes that it seems increasingly unlikely and that they will go in July, but we still have payrolls and we also have another inflation report. So I think the one thing that we're pushing for is that our inflation forecasts underscore the fact that disinflation's happening. Even from a global perspective, we're seeing it globally in all these countries that we track that disinflation's moving. It's just not moving as fast as policymakers would like, but we also see the U.S. economy slowing more significantly more than others in the second half of the year, which means that they don't need to keep moving forward.
Okay, two calls there, one on inflation and one on growth. Let's deal with inflation first, and let's deal with the data in front of us. Set the bar for us. Payrolls on Friday, tomorrow, 225 is the estimate. CPI next week, core CPI, the estimate right now, month on month, 0.3.
Yep.
Where does that data need to be for your call to deliver?
Right. So I think on non-farm payrolls, this is the one thing that's interesting. We're not opposed to stronger growth, because when you have stronger growth and you have disinflation, that's what helps the soft landing narrative. So I think that's quite important. So we are slightly above consensus on growth tomorrow. We're looking for, I think, 250, 260 in terms of NFP, but we're looking for a 0.2 month over month print on inflation. And that's the most important part.
Core CPI or headline?
Core.
Okay.
So that's what allows us to move essentially into disinflation category. Because the one thing I think that people are missing is that inflation surprises globally, particularly in the U.S., not in non-U.S. G10. But if you look at emerging markets, U.S., Asia, inflation is surprising on the downside relative to expectations. And when you look at consensus of revisions on inflation, all those numbers, we aggregate them. Yeah. I think this is one of the values you do in FX, because you're looking at the world as a whole rather than being a country-level economist. If you look at inflation expectations over time relative to consensus, we've seen about 60% of the countries we track with disinflationary forces over the last 3 months. So what's good is if we get good growth numbers, the Fed doesn't have to be worried about that if disinflation is and inflation numbers are coming in softer than expected, which is what we're anticipating.
Okay, somebody out on Threads just emailed into me and they said, can you talk to Mark McCormick about peso? Okay, I'm looking at Mexico. Forget about Trump, Clinton, and all that. I took it back to 1995. I did a log extrapolation, a regression analysis of the weakness in Mexican peso forever. We've now advanced strong Mexican peso, almost 3 standard deviations, like we've never seen since 1995. How does that change life in Mexico? How does that change life for America?
Well, the big part of it is the Mexican economy is linked specifically to the U.S. economy. So one of my favorite indicators when you track Mexico is USM, ISM leading order, ISM new orders component. It's actually good at capturing the manufacturing base that Mexico has coming into the U.S. I don't think the strength of the currency is a detriment, because what Mexico's doing, it's stuff that Canada did 20 years ago. It's kind of an intermediary of pulling things together and then basically shipping things back off into the U.S. So the currency doesn't have a dramatic impact, where if you get a stronger currency, you're not going to get this negative impact to growth. We've seen over even the last 10, 15 years, those models of international trade, where if you get a stronger currency and then essentially you see slowdown in the economy, they just haven't worked. And again, there's usually 2 to 3 years worth of lags in those models, but what we see and how we tested them, they're not working. So I think the most important thing that's happening in Mexico is it's been linked to the relative strength of the U.S. economy, right, but it's also the best performing carry currency that you have across the world. So Brazil, Peru, Mexico are 3 of the highest yielding low vol currencies.
So do you go against that belief, and do you go weak peso looking for 17 or 18, 19?
No, I don't believe in the weak peso story, because I think fundamentally the flows are changing. I heard John, your prior guest talking about the geopolitics between U.S. and China.
Sure.
The retweaking of global supply chains is very bullish for the Mexican peso.
Just help me understand one thing. Reconcile this. You mentioned the new orders component of the ISM manufacturing. It's been sub 50 since the end of last summer. Why the call for the Mexican peso then?
Well, the thing is U.S. data strength. So a couple of things you can track. You can look at data surprises, data strength, PMIs, ISM, consensus expectations. If you look at the strength of U.S. data, it's at the 100th percentile of rolling last 6 months. So U.S. data is coming in strong. U.S. data surprises are in like the 50th percentile. So it's kind of coming in better than expected.
High since 21.
Right. And so the strength of U.S. data is still insulating the Mexican economy. So no one's looking for Benico to cut until the second half of the year. And again, that kind of falls in what our expectations that Fed will cut in December. So the thing is, the resilient U.S. economy from a data perspective has helped the Mexican economy be generally resilient. At the exact same time, we've pushed back expectations that Benico will cut. And even if they do cut, you're still looking at double-digit interest rates, where again, what you need to break this carry trade apart is the global recession, which we're not calling for in the next 6 months.
What is the call on Chinese growth?
So Chinese growth, to me, is we're still sub 6%. We're probably 5.5 to 5.8 now. I think the big thing with the China growth story is that it's peak pessimism. If you think about how this was linked to the dollar, I know there was a lot of focus on the U.S. strength of the economy and the Fed in May. The bigger driver of the dollar that I see in our models is the complete capitulation of China data surprises, which went from 3 standard deviations to negative in about 4 weeks. So I think part of it is the market's gotten so pessimistic on China, it's gotten so pessimistic on Europe. Our models show that relative to what we're expecting, there's value in some of the Asian currencies. So what we like doing here is easing of financial conditions. The rate differential story is not great for the renminbi, but it's good for the Thai baht. It's good for Korea. The idiosyncratic story in India is good. So Asia in itself is a relative value play on a I would say not a weaker but a relatively less strong renminbi.
I've got 45 seconds left. You threw Europe in that bucket as well. Where does that leave the euro?
Euro it's become somewhat boring in this context. It's in a 107 to 110 range, and there's a push and pull. So the growth story has gotten really weak, but at the exact same time, what you still have is in terms of trade is still a general boost. You still have some decent momentum, and at the exact same time, what we see in like natural language processing models that look at what central banks are saying, ECB is more hawkish than the Fed. So we're expecting more from the ECB. We're expecting less from the Fed. So the rate differential story is also actually supportive of euro just kind of being 107 to 110. And our call for the U.S. to slide into a recession and poor European and Chinese data to reverse and good U.S. data to move the opposite direction reinforces that euro should break 110.
You're using those models in-house, those language models in-house?
We're all playing with them, yep.
Very cool. Interesting. Mark McCormack at TD Securities. Mark, thank you. Thank you for that. From New York City this morning, welcome to the programme. If you are just tuning in, equities right now on the S&P 500, negative about 0.5%. Coming up in about 30 minutes, we'll continue this conversation with Andrew Hollenhorst of Citi. And coming up shortly, Dan Ives of Wedbush. TK, this will be cool. On the latest with your new addiction, Threads.
Yeah, I could care less about Meta. I just never got it. I still call it Facebook, but it's a perfect time to talk to Ives. Get off the Apple bandwagon. We always end up talking about Apple with Dan Ives, how they're going to do here in the earnings report. But yeah, today's a Meta day with Dan Ives, no question.
Elon Musk too. Wear the sleeves, Twitter,
I thought
and
Alex
ultimately leadership at Tesla too. Dan's going to have tons to say about that.
Yeah, well, how's he respond? I don't get it. The underlying mathematics to me is fascinating. Where do you get a critical mass? Where do you get an emotional mass that tips it? My guess is we're farther out than I think, but I don't know.
Twitter feels messy. Tesla's having a great year. Do you see deliveries in China? Pretty decent.
I've never gotten it.
Stock's doing really well year today.
I missed it, and I've never gotten it, and I still don't get it. I still don't. Frankly, while you're going, Bramo was really good about this. All these Rivians
I've got to tell you this. While
you were
gone, how many times have we heard that phrase while you were gone this morning?
I don't know. It's like it's like a Kelly Clarkson thing. Since you've been gone.
Did you miss me? Is that what this was? Why can't you just admit it?
I can't even. I can't sleep at night. Vet bills. I'm in therapy on it. It's expensive.
You couldn't sleep at night.
I'm vulnerable. Come on.
I know. And it's a sensitive issue. It's okay. I'm back. You're going to be okay.
Okay.
I'll hold your hand. We'll walk out of work together a little bit later.
Since you've been gone.
Is that your singing, Kelly Clarkson?
Yeah, great song.
That's a good song.
That's a great song.
We should play music on this show.
Don't get me going.
We did that when we did this on radio, and it was just on radio and wasn't on TV.
We programmed it, and I programmed it, and John insisted we play Clash.
No, I wanted to play Oasis, and you got it banned.
No way.
He actually got it banned.
No way.
What's the story, Morning?
Since the bull market has mostly been in the technology stocks, the question is, do you see a pickup in other sectors that either catches up to technology, or do the technology stocks keep running and people keep chasing those? I think the problem with technology is that once those headline names that are so big in the indices start running, it's very difficult for the rest of the stocks in the indices because they get bigger and bigger. So you have this math problem where the giant stocks get bigger and they push the indices higher and don't drag the rest of the market with it.
Big tech just keeps getting bigger. That's been the story of the year so far. Meta up by more than 100%. You look at gains elsewhere, take your pick. Nvidia, Tesla, Microsoft, Apple, up double digits across the board. The S&P 500 up by more than 10%, something like 16% higher so far year to date. The Nasdaq up something like 40. This morning, futures negative by 0.5% on the S&P. Yields a little bit higher by 3 basis points, 396.34 on a 10-year. The conversation outside of the cross-asset analysis and financial markets very much on the spat between Elon Musk and Mark Zuckerberg, and it gets real overnight with the unveiling of what they're calling threads over at Instagram, a direct challenge to Twitter, Tom.
For John and me, this is a non-event, but unfortunately, it's so important. I think, John, we got to get right to it.
I would do that right now, sure.
Is an important voice on this. Dan Ives has earned the credibility. I'm going to say 8 months ago, he was the dumbest guy in the block. How dare you think we're going up? And we have had a Dan Ives market from the third week of October 2022. I got to get the threads, but what did you see in October of 22 the rest of us did not see?
I think it was fundamentals that were going to be a lot more stable than I think a lot of the skeptics thought. What we were seeing specifically in cloud, in enterprise, and even when it comes to consumer, with names like Apple, we just felt like the bark was worse than the bite. And then starting in the fall, that's when we started to do our AI research. And in my opinion, it was going to be the biggest transformational trend that we've seen in tech. And I think as that's played out, that combo is sort of where we are today.
I got 8 other questions, but we've got this idiocy this morning. Threads, can it get critical mass?
I think it's going to be very difficult to get critical mass. I think right now the name of the game for Zuckerberg and Meta is just further expand the Instagram base in terms of the cross-sell opportunity, eventually advertising. They're trying to strike while the iron's hot, given some of the issues we've seen with Twitter and Musk. But getting to scale is going to be difficult, but Musk has left open an opportunity here. We saw what happened this weekend. There's a lot of frustration building, and I believe this is just the drum roll to what's going to probably be the cage match this fall.
Looking forward to that cage match too. Let's dig into that. Define critical mass. What is that? What's the number?
Well, I think you really have to start to get to something I'll call 30, 40 million users. When you start thinking about where we
That's
really
what you've
need.
got. That's what Bramo has.
They're going to have that by the end of the week, aren't they?
But 30, 40 million users, you need engage. It's not just about the users. That's the one thing you'll see. Sign-ups in the first 7 hours, 10 million, 20 million.
Sure.
It's about you get to 40, 50 million, then scale to 100 million plus in the next, call it 6 to 9 months. But engagement on the platform is key. That ultimately.
Doubts about that, Dan, but I wonder why, because Instagram already has this preloaded base. They can port directly. I did the sign-up yesterday. There's no friction there at all. It's really, really easy to execute. Why do you have doubts?
It's really because if you look at anything that's tried to challenge Twitter in terms of any of the other platforms, it's been very difficult to scale. Now here, for Zuckerberg, you got 1 billion plus users you could tap into. They've had limited success, I think, scaling other standalone apps. And I think right now, the question is, how much resources are they going to put into this? And is this just sort of a moonshot type project or something that they really want to scale? And look, I think for Zuckerberg, they went from a position of massive weakness, going back to, when you talk about 8, 9 months ago, to now it's a flex the muscles moment for Zuckerberg.
Sure.
Especially going toward Musk.
You're not on here yet.
I'm not.
What are you waiting? Come on, you're Dan Ives.
I'm waiting until
waiting.
I was waiting for you, but
he's made his move.
Ferro's on.
So now that Ferro and Keene are on, I'll go on.
Mark Zuckerberg says this: I think there should be a public conversations app with 1 billion plus people on it. Twitter has had the opportunity to do this, but hasn't nailed it. A lot of people have had the opportunity at Twitter to do this, and they failed. What did they get wrong? And we're still trying to work this out. And why is Mark Zuckerberg the man that might be able to do it?
Yeah, I think it's monetization. I mean, if you look what Zuckerberg's been able to do, obviously with the Meta platform, monetizing has obviously been key. Ultimately, that's been the issue for Twitter. That's been the uphill battle. They're trying to get it from verification, subscription, every which way. And I think that's been the big challenge for them, especially in this essentially arms race that's going on in the space.
Define Liz Ann Saunders was just on. We all agree it's been a multiple expansion. How does a growthy guy like you, an Apple fanboy, how do you adapt to the multiple expansion of the various and sundry wonder stocks of the last year?
Yeah, I mean, I view it, especially when I look at a name like Apple, where you're going into a mini super cycle with iPhone 15. I think multiple expansions are really about the increased opportunity to monetize an install base. It's all install base based.
So it's this ecosystem baloney.
But that's why what's happening in Redmond, what's happening in Cupertino, I think it's really been what's on the other side of the mountain. And I think that's really the key.
Are we just running our terminal value out if the CFA says 5 years, 7 years? Are we all buying Apple because we think it's a 9-year terminal value buy?
That's exactly my view.
I did okay on that?
Look, you're the professor and the tactician, the master. Okay. And I think here, when you look at Cupertino,
Dan can come back.
But that's why we believe $3 trillion. This train just doesn't stop.
The biggest problem, you don't see this on radio, but he dresses conservative for us because
he's very
you and I are
today.
So conservative.
This is highly conservative.
You know, he's got like it's a clashing. Like the shoes are outrageous. He goes on Wapner. And he's dressed like, you know, it's party time Friday afternoon, 4 p.m.
They dress down over there at the stock exchange?
No, they don't dress down. They just dress, it's like a cultural thing. He dresses, he might as well wear a tuxedo when he comes on this.
When I'm with such debonair, like the way, like someone like Keene, I need to dress a little down. And then later, I'm just going to go on Threads.
Apple, buy Target. Give me some update here. We're coming into earnings season. They going to do it again?
220 base, 250 bull case. I think this now starts the road to $4 trillion, in my opinion. I think it's going to be another trophy case, not just quarter, but in terms of what we're seeing going into iPhone 15 into September for Cook and Cupertino, which is why I believe this is really just the start of this next cycle.
This is a secret on Ives. He actually knows the data. How many people like John Tucker and Bloomberg Radio have an iPhone that's 400 years old or they're going to bite for the new toy?
It's John Tucker and 250 million other individuals that have not upgraded their iPhone in 4+ years. That's the key. And that's ultimately why right now Apple continues to sort of own it and everyone else is paying rent.
I'm holding off the upgrade at the moment. I just don't see anything in the new iPhone that I particularly want.
I'm addicted. To me, it's a chip technology. This new phone.
Is it quicker?
Don't buy it. Don't buy it. You buy it just for the battery life.
Is the camera better?
The camera's better.
Yeah,
you buy it for the battery.
That's exactly why I end up upgrading, because they kill the battery. They get in there.
The new phone's got what? More whiz bang?
You know what they do.
Come on, you talk to Gurman.
Look, and ultimately, what I believe here, it's not just about technology we're going to see on the camera side, what we're going to see on the chip, but I think it's really going to be at the software, because I believe this is really the start of what's going to be the AI ecosystem being built out in Cupertino.
I've asked you this before. You've got to have a better answer this time. I didn't like the last one. What are you talking about with Apple and AI? What is it?
What it
Siri on steroids?
No, because ultimately 12, 18 months from now, you are going to have a separate app store for Apple that's AI apps only within the ecosystem. And I believe for developers, and in terms of the sum of the parts, that could ultimately add $40 to $50 per share that we see for Apple. And that, I think that's the next leg of the stool, along with the Apple car in 2026.
2026 for the Apple car. That's a call.
Yeah, and I believe it's a matter of when, not if. And it just shows, as much as the haters continue to yell fire in a crowded theater saying innovation's done at Apple, yet again, they continue to innovate. And that's why Cook is Hall of Fame CEO tactician like he is.
Okay. Dan Ives of Wedbush, Dan, good to see you.
Great to be here.
As always.
Good update. I just followed Lando Norris.
Okay.
On Threads.
Did Lando follow you back?
No,
Did
Lando didn't follow me back.
Lando's busy.
You know,
okay.
How about, should I follow Girls Think I'm Funny?
Maybe. I don't know what that. I don't know what that account is, Tom. So I can't.
It's just.
Back that decision.
Gary V's on here. I mean, you know.
He's an interesting guy.
Yeah, you know. It's,
all right.
It's like.
Let's see if Dom Constant's on it. Dom Constant of Mizuho is going to be joining us very shortly from New York. Futures near session lows negative 0.5%.
We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates.
If the inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable.
The higher they go with the Fed funds rate, the more likely they are to reach their target of 2% inflation.
It feels like they're sort of locked in for this July hike.
They're going to hike one more and then they're done.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. An important Thursday for economic data. We welcome all of you on radio and television. John, in 29 minutes, it begins for 25 hours.
It's the runway to July 26th, which is the next Federal Reserve meeting. A little bit of information between the last meeting and the next one. A CPI report next week. Payrolls tomorrow. And in between now and payrolls, we've got an ADP report in about 15 minutes. Jobless claims in 30 minutes. And in about an hour, 2 hours from now, you get more information. Job openings, Tom, and the ISM.
This hour, must watch, must listen for Global Wall Street. For the rest of you, Hollenhorst, Constum, that's the kind of people we're going to talk to here. And John, it comes from ultra-accommodative to accommodative. And as Dominic has talked about, we're up here at this restrictive level, and they want to go even more restrictive.
How restrictive are we? You've got Hollenhorst, who joined us, as you mentioned, in 15 minutes. Andrew says another hike at this month's meeting, another hike at September's meeting, and Tom, and then maybe they're done. But we've had this conversation, I think, 2 or 3 times already this year.
Yes, I agree.
The Fed's about to go on pause, the Fed's about to go on pause, and now we've got some people still talking about September hikes.
Most important thing I've heard today, John Ferro talking about yields, the description, the Bloomberg terminal in London, in the city, and the fact is, you said, but the UK economy just perseveres.
Yeah, upside surprises. If you look at the indexes, surprise indexes, both in the UK and the United States, positive surprises in the economic data, reintroducing a conversation about higher interest rates, inflation not coming down fast enough in places like the UK. But Tom, these numbers, I think you have to go back to early March. You've got a 2-year sitting just north of 5%. You start to hear about banks we don't often talk about, SVB.
Right.
People start discussing the banking crisis. We've got bank failures, real bank failures, playing out before our eyes. And people turn around and say, the Fed is done. We're going to have a credit crunch. And this is the beginning of a process. Well, maybe this is the beginning of a process. I don't know. But that was what the conversation was at the beginning of March. I talked about it a million times. And here we are, several months later, with a 2-year yield just short of 5%. And a conversation about high interest rates at the Federal Reserve.
30-year bank rate mortgage goes right out, pops up like a 7.05 out to 7.1, whatever, really breaching out near new highs. In the summary of this, John, to get to the data quickly here, to get to Dr. Constum, to me, the summary here is what Ed Hyman said yesterday of Evercore ISI. He's never been this negative on an economy. For that from Hyman is a huge statement.
Equities right now on the S&P, negative 0.5%, a bit softer, a touch softer yesterday as well. Let's see if we add to the weakness through today's session. Yields just a little bit higher here, up by 3 basis points. A 10-year just short of 4%. A 2-year just short of 5%. And a euro right now just short of 109 against the dollar. Tom, 108.92.
Long ago and far away, I was in Tokyo, and a gentleman from Credit Suisse came up to me and said, thank you so much for telling people about our world-class literature. We say this now, of course, with the death of Credit Suisse. And all of that effort was led by Neil Sauce, who got me really helped jumpstart everything I do here. And under Neil Sauce was a guy named Dominic Constum. He and Ira Jersey led a world-class team synthesizing all of this mumbo-jumbo together. We are joined by Dr. Constum now at Mizuho Americas. Dominic, I'm going to cut to the chase. You invented super restrictive. Does Jerome Powell want to become super restrictive?
Well, I think he's obviously already super restrictive. And I think the only reason why they would be willing to unwind that will be either if you get a faster fall in inflation or you see the labor market beginning to loosen up materially, which, a combination of both we think will happen. I think the panic, if you like, back in March, going into sort of April, May, when rates were very low, the curve was steepening, people were focused on the banking crisis. That panic has obviously subsided, thanks a lot to what the policymakers did. But there's still a scar on the economy that I think you're going to see coming through.
John, in our opening, you mentioned this, the idea of March, and we forget the bank trauma. While you were gone, we had stress tests, and you'd think we'd move beyond the trauma. I'm not so sure.
Drink.
That's
our new drinking game while you were gone.
Yeah, but it's Jenny Cream Ale. That's what we're using.
Okay. Nothing too hard because you're mentioning it so much. Dom, just to build on that, you said the scars are there and they're going to start to come through. That indicates that you believe a process did begin back in March. Could you shine a light on that a little bit more, Dom? What are you seeing that is taking place at the moment that you think will come to the surface?
Well, we know that credit conditions have tightened a lot in the survey data, and that anyway works through to a lag in terms of lending growth itself slowing down. And you can see in the weekly data, lending growth doesn't look particularly good, particularly for the larger banks. So that's sort of one issue that's already in place. The other issue is really the net interest margin story. So you're going to start getting the bank earnings, and NIMs are going to get released. And you can model NIMs, relatively straightforward, and they're going to deteriorate. They're clearly going to deteriorate. The curve is very inverted. NIM compression, I would argue, is very much in place. Again, it takes a few quarters to properly see through. But we're talking about a swing of a few $100 billion potentially, as much as that, in terms of what could be taken out of bank earnings, essentially. And that's just from a sort of top-down macro view. And then, of course, the issue is how that's distributed across the banks. Some banks are going to be much better placed than other banks to deal with this. The ones that really had to fight for deposits, if you like, are going to be the ones that will come back into focus. So the policymakers have done a lot, I think, to put to ring fence a crisis in terms of sort of a banking systematic sort of problem. But that's all going to sort of feed through still into weaker lending growth. And that collides with what we think is going to be a loosening up of the labor market, because people are kind of, there's too much labor hoarding going on, not yet enough labor shedding going on. But that transition, I think, will take place in the fall. So we've had obviously a bit of a round trip in markets. But I think the fundamentals behind the outlook for the economy are still a little bit, very much concerning. If we can get a soft landing, fantastic. But a hard landing is very much still on the radar, I think.
Tom, we need you to build on that just a little bit more. You mentioned how some of those banking issues might be distributed across the banking system. How that will be distributed across banks, small through to large, will have implications for how it's distributed through the economy. Can you give me that element of it? Dom, how do you think this will show up in the broader economy? Is it just small sections of the economy that starts to struggle, or is it a broader issue?
No, I think it's going to be a little bit like what we've already seen. I think it's going to be the combination of the banks that perhaps haven't had the benefit of earning at IOER rates at the Fed. They haven't had the excess reserves perhaps, so they've had to on their income side it's been a bit more difficult, and in addition they've had to fight for their deposits. So that's going to be probably the same sort of thing that we saw before. And in terms of the economic impact, you can just look at the sectors where there's clearly been sort of overemployment. I mean, technology is obviously one. So I think that's kind of where you'll probably see the stress.
Years ago, Dominic, the most famous chart you generated was how everybody was consistently wrong predicting higher rates. And there were these little wisps on a Credit Suisse model of wrong over time. I'm not saying you were wrong. I'm saying the entire street was wrong. What's the chart now that indicates how wrong we are? What's the chart now that we're just getting it wrong?
Well, I mean, I guess, the way in which the Fed expects, if you're going to look at the same kind of hair charts we used to call them, whereby the market had always consistently overestimated what the Fed was going to be doing, you can certainly argue that the market has tended to underestimate the commitment of the Fed to sort of maintain rates at an elevated level and keep pushing through. So if you go back a year, we were pricing for cuts and come this year, and obviously the market's not there now. So it's been wrong on the other side of that. So,
that's why we're dovetailing you with Hollenhorst from Citigroup here. We're getting two different views. If we get an Andrew Hollenhorst market with 2 rate increases, how does our world change?
Well, I mean, every time they hike rates, I think the market is not going to be convinced that they're going to have to do even more. I think it's more like they hike, but that's the last one sort of thing, or at least they reduce the probability of the next hike. So the market is very much, and that's just a function of the super restrictive. I mean, there's no way you can look at the market in any kind of sort of context and say that the Fed isn't very, very restrictive in terms of where real rates are. And it's just a question really of what your view of inflation is. If inflation inflation is coming down. If the Fed doesn't do anything, they become even more restrictive. And that's very important to realize that even if the Fed does sort of get rates up to say 5.5% or even 6% and keep them there, unless you think inflation is also going back up again, then that policy will become just even more and more restrictive, and they're going to have to unwind those rate hikes very quickly. Otherwise, they will collapse the economy. And when we look at inflation, I actually think the inflation picture in the US is looking pretty good. The core services side has come down, and the goods side is bad because of used cars. But you know what? No one's actually buying that many used cars. In real terms, the real purchases of used cars has been going down for the last couple of months, but that's because the price has been going up. And that's just a sort of supply side issue. And that's not really, in my view, what the central bank should be really focused on, that they should be focused on demand side inflation. They can't really help the supply side. So that's why we get into this sort of concern around this really restrictive sort of policy, and why you get this tail risk of a harder landing. When it all goes wrong, it's going to go wrong pretty quickly. And that's why the Fed may have to reverse course very, very quickly.
Dom, amazing. Dom Constant there of Mizuho Americas. Can I ask one thing from an audience, if you have 10, 15 minutes? Go back to yesterday and listen to Tom Tsouras of Strategas, and then replay that conversation we just had with Dom Constant and make a decision. Who's convinced you? Because on the one side, you've got Tom Tsouras saying something completely different to what Dom Constant and Mizuho just said.
John and I are off for a game today. We're so threadsed up here. We're just missing the legacy back 24 hours. Jim Bianco, Tom Tsouras, talking about disinflation, where you are sticky, you come down, and then you either stop, or as Jim Bianco talks about, rates actually go up. Nobody's modeling that in. Nobody.
It's amazing. Polar opposites in the last 24 hours. If you are just tuning in, welcome to the programme. The S&P 500. Equities right now negative. Session lows, negative 0.62%. Coming up in about 5 minutes or so, Andrew Hollenhorst of Citi on a slew of economic data. That economic data begins with the ADP report just moments away. At the corner of my eye, I can see Mike McKee's just entered the studio, TK. So Mike's going to break that down for us. The ADP report, the expectation, the median estimate in our survey, 225,000. The previous number, Tom, 278,000.
It's a huge two-day concentration here. And, McKee talks about the JOLT survey. He's looking at the underneath the headline data. And he taught me this. The media is focused on 3 or 4 numbers, and you can go that afternoon over a beverage and say, OMG, did you see the unemployment rate? But there's a lot of dynamics under here. And what I'm fascinated by at the heart of the matter, you mentioned Neil Dutta earlier, how does all this synthesize down to everybody being wrong on a GDP guess since time began? That's sort of where I want to be in 25 hours.
I think a lot of people have been wrong this year, Tom, on both the economy and on the market as well. So the economic data comes out in about 2 minutes' time, the ADP report, and then it's on to jobless claims at 8:30 Eastern time, so about 17 minutes from now. Then after that, you'll get job openings, the JOLTS report. Mike will give you some colour on that in just a moment. Then a read on services in America, an important sector, of course, for output in the US economy. Manufacturing is dreadful. All that recession talk, manufacturing is in a recession worldwide. If you look at the indexes that we get from the likes of S&P Global, most of them are sub 50 on the manufacturing side of things, Tom. Services is still robust. I go back to what we talked about yesterday, how those two things converge. Is it manufacturing up to services or services down to manufacturing? It's an important topic of debate.
It includes boat rentals in Italy. I mean, that's what services
contributing.
are so good.
Contributing. Yes, yes.
I am the most bearish I've ever been on the economy without being in a recession. And it's because of the yield curve, the contraction of money, and QT at the same time they're hiking rates. That blow hit to the economy is going to cause a recession, but it doesn't happen overnight.
Ed Hyman of Evercore, just absolutely fantastic yesterday. You can find a full conversation on Bloomberg.com and on the Bloomberg terminal. Remember this phrase, nobody cares about the ADP report. And then the number comes out from ADP, Mike McKee, and it's a big one.
It is a very big one. Tom, call Ed Hyman, ask what he thinks about this. 497,000 jobs created, according to ADP, during the month of June. That is well in advance of the forecast for 225,000, way ahead of the revised 267 that they say we got in May. Now, ADP for months and months has been coming in lower than the non-farm payrolls number from the Bureau of Labor Statistics. And so if we got a higher number from BLS, you can only imagine what the market would reset to. The numbers are really interesting because most of the hiring was in leisure and hospitality still. And although they seasonally adjust these numbers, I'm not sure if they've got it exactly right, because 232,000 jobs in leisure and hospitality. Now you're going to open all the beaches, the lifeguards get hired, the amusement parks open up. That would increase employment in those areas. But 232,000 is a very, very large number. And you get this 497,000 guys with a loss of 42,000 jobs in manufacturing, according to ADP. So this is quite a number, and it's going to be really, really interesting to think about it tomorrow morning at 8:30 Wall Street time.
Let's push it through the bond market first of all, Mike. Yields up at the front end on a 2-year by 7 basis points. We reclaim 5% at the front end of the curve. On a 10-year, just short of 4 at the moment, but about to get there at 3.99. And we break 4 on a US 10-year. Yields higher by 7 basis points. So through 5% on a 2-year, through 4% briefly on a 10-year. And in the FX market, dollar weakness this morning. Dollar making a comeback now post that number. The euro back down to about 108.62, so well off session highs. Looking at the equity market, we are negative now at session lows. We're down by 0.65%. If you are just tuning in, big upside surprise, 497k on the ADP report. The survey was 225, and TK, that's the appetizer. Going into payrolls tomorrow and just ahead of jobless claims in about 12 minutes' time.
Let's sell forward to Michael McKee's busy morning claims here at 8:30. I'm going to say ISM services, John, is also suddenly germane at 10 a.m. before we get to jobs tomorrow. Mike, John, I want to point out the 10-year real yield explodes is the word I'm going to use, out to 1.75%. That's a big
It's amazing.
number.
I think, Mike, you did a great job of framing what's happening with manufacturing and what isn't happening with services. Do you expect to see that in the ISM in about 2 hours' time?
That's been the general pattern, although the ISM for services employment numbers were negative. They were below 50 last month. So do we get that again, or does it start to go up again? I mean, in theory, if you get these kind of numbers at service establishments, especially leisure and hospitality, those numbers should go higher. So we'll see if this is an outlier or not. One other important point, ADP has now started publishing a pay survey. They've been doing that for some months now, and according to the pay insights, the overall pay for employees increased 6.4%. If you stayed in your job, that's down from 6.6% in May. Job changers slowed for the 12th straight month, 11.2% raise. That's the lowest since October of 2021, they say. So we're getting all this job creation without, in theory, significant wage gains, or at least they're slowing, which if the Fed were to look at it, they probably would like that. I'm not sure they would. They do use, interestingly enough, the Fed does have its own private index of employment, and they use ADP data to create it. It's not the same. It's not the same index, but they do use it.
On in 9 minutes, Michael McKee with claims. Right now, he was an outlier. He's not anymore. Andrew Hollenhorst has led its Citigroup. He's our chief U.S. economist on 1-2 rate hikes. All of a sudden, with a number today, Andrew, I'm interested in September 20th. And I'm absolutely, my head is spinning over restrictive. Are we close to restrictive in our complex mathematics of this economy?
I mean, I don't know that you need to go into the complex mathematics. We can, and I think that's important. But if you just step back and you look at this labor market data in particular, we've surprised month after month to the upside. we continue to see these jobs numbers coming in stronger. And I think Mike gave all the right caveats around ADP employment. There's a lot of reasons that can differ from the official payrolls reading, and we have some big seasonal adjustment issues. All of that I think is right. But just take a step back, look at these jobs numbers, hundreds of thousands of additional jobs relative to expectations that have been created. That's a signal that maybe we're not at appropriately restrictive rates.
Is that an appropriate signal? Is that a lagging indicator, Andrew?
That's the big issue, is the Fed is making policy now, looking at data that is going to depend on their lagged policy making. And I think the bank issue, the credit tightening, that's something that probably still is going to be working its way through the economy, slowing things down. The concern, though, is that some areas have already been worked through. If you look at the housing sector, we bottomed in housing. We've come off of that bottom, and we didn't lose construction jobs. And that's a great thing for construction workers, a good thing for the economy. But if the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
Can you help me with that? That's been a key question for me in the last 24 hours, and I'll keep digging into this too with other guests later on Bloomberg TV and on Bloomberg Radio. When you look at the surprise indicators, that index is the highest it's been since 2021. So that's the incoming information relative to the estimates before that economic data. Is that because things are better than expected, or are things getting better? Are they actually improving?
I think it is better than expected, and this is really theory versus data. And the theory would tell you interest rates are higher, real interest rates are higher, that tailwind from lagged fiscal stimulus should be coming off. All of those things should be slowing the economy, and we think we see some signs that some of that slowing is happening. But job growth has slowed down. It used to be running 1 million a month, and it was running 500,000 a month, but it slowed to somewhere around 300,000 a month, and that's just a lot faster than anyone would have expected at this point.
The arch issue here is Ed Hyman looks at a very, very weak economy, and yet we've got service sector doing this and that. Does Citigroup look at this as a weak economy after 2% GDP adjusted in the first quarter?
I think this cycle is just so different that some of the standard indicators of weakness are not working the way that they have historically. One example John was talking about before, manufacturing. Manufacturing ISM showing contraction, that's usually a good leading indicator of recession. The housing sector being in contraction, that's usually a good leading indicator of recession. But this cycle is different. We have this transference to services spending.
In the continuum here, are we, as Constam just mentioned from Mizuho, are we where it's a pandemic supply side analysis, or is it a demand driven analysis for the Fed?
I think you have to do them together. And I think that it's a commonly made statement now that, well, central banks should be focused on the demand side, not the supply side. You have to focus on where is the demand side relative to the supply side. And unless you think the shock to supply is some very transitory issue, and a lot of the issues that we have on the supply side now are structural and will be with us for some time, central banks need to recognize that supply side and then adjust demand accordingly.
Looking forward to bookmarking the address from Chairman Powell in Jackson Hole next month with the address from last year and comparing where unemployment was there and where it is now. Because we're looking for that to come in at 3.6%, which is basically where it was, where he was addressing the public, talking about causing pain and potentially pain in the labour market.
I'm in the camp a la Sintra that this isn't in the textbooks, as Andrew alludes to. Post-pandemic, it's both sides, supply and demand, and we're just making it up as we go. They're wildly exposed.
497,000 on ADP.
Yeah, I mean, McKee.
It's almost a laughable number. Yeah. It's like kind of ridiculous when you see a number like that come out. Just a monster upside surprise.
Yes. I mean, Mike, is there one color here that you can give us before claims?
I don't think there's a particular color other than to say that the initial reaction from most economists is this is kind of an outlier. It's hard to explain. The small businesses added 1 million different jobs, and that's not what the NFIB has found.
Mike McKee coming up in 5 minutes. He's going to break down jobless claims. Andrew Hollenhorst of Citi responding to that. A 2-year through 5%. 10-year yield through 4%. On that debate, Christian Mamani thinks there's upside risk. Potentially that's the pain trade for high yields. Mike Kontopoulos of Richard Bernstein taking the other side. And should you sell the low volatility? Amy Wood Silverman of RBC on that at the opening bell.
Bloomberg surveillance. If you thought it would be a quiet start to July, you are wrong. We see history in the interest rate market right now. The 2-year yield 5.03%, up a solid 9 basis points off a bang-up ADP report. And the data, well, we'll slide into it here in 6 seconds, but we have a new sobering reality. Michael McKee really, really matters for the next 25 hours. The trade balance boring comes in on plan. Michael McKee, we're waiting for claims. How do claims, Michael McKee, dovetail into the ADP report?
Well, I can tell you they come in a little bit higher than anticipated at 248,000. That is higher than the initial report of 239 last week, but it is also higher than the anticipated 245. So a bit of a rebuild in claims. Now, this is a tough time of year to get claims right because you have a couple things going on. We had a Juneteenth holiday that was in the last report, which is now revised down to 236, and that's a new holiday, so hard to seasonally adjust for that. And then you've got the auto industry shutdowns that come around every summer. So I wouldn't put too much on the actual number, but the level change is a little bit stronger, but it's still nowhere near telling you that we have a big layoff problem going on. Right. 1,720,000 continuing claims. That's down from 1,733 the week before. So the people who are getting benefits has fallen back, which is tells you something as well. So that's 2 out of the 3, or 2 out of the 4 today. We'll get jobs, the JOLTS numbers, and we'll get the services employment numbers coming up. And then watch that 225 survey for payrolls tomorrow. That may change.
The survey may change before the jobs report.
Before the jobs report, because if we get all this strength, people might start to build some of that into their anticipated numbers.
Futures deteriorate, negative 33 on the S&P futures. We're out of stick on the VIX, 15.29. The 2-year yield's got a life of its own, up 13 basis points, 5.07%. Think what that money market fund at Citigroup is going to do. We have the honor of continuing from Citigroup, where he has a 7.2% 6-month CD. Andrew Hollenhorst is with us, their chief U.S. economist. I want to go to what matters in the textbooks, which is not the yield of the 10-year, 4.02%, up 9 basis points, but a 10-year inflation-adjusted yield measurement of 1.77%. Given the Hollenhorst rate structure, given the Bill Dudley rate structure, given the Mohammed El-Arian rate structure, where's a comfortable real yield that we can live with?
I think you're going to the right place, Tom, which is that 10-year inflation-adjusted yield. That's going to control the level of activity in the economy. And what we've seen historically is those level of real yields need to get up above 1%, maybe even above 2% to really slow the economy. So that's the first thing to keep in mind on the real yield story. The second thing is, what is the inflation number that you're subtracting? That's really the key question. If you're subtracting 2% inflation, then an approximately 4% 10-year Treasury yield is going to be a 200 basis point real yield. If you're subtracting 4% inflation, then we're at 0 real yield. So that's really the question. I think the question is, where is inflation going to run structurally?
And UCLA 101 there, what you got from Hollenhorst is you got 3 statistics. You got the nominal yield, take away the inflation rate, that's movable, and that gets you to a real yield, the residual off the back end. One of the themes we're hearing on the show from smart people is the stickiness of our disinflation. What is your call on disinflation? Do we get to 3%, whereas Jim Bianco states we could actually reverse or stay there for a good amount of time? What's your call on inflation?
Yeah, so we have some positive dynamics over the next few weeks, actually, in the inflation data, where you should see used car prices coming down, shelter prices should be slowing. So there are reasons to think we're going to slow into the end of the year, probably get down to something like a 4% underlying core PCE pace, maybe into the high 3s. That's all good news for the Fed. The issue is looking further into 2024 now. If this housing rebound continues, if house prices continue to rise, if the labor market stays tight, then it's really hard to tell a story where inflation is disinflating further and you have risks that inflation actually increases. So that's not our base case outlook, but I think those risks are becoming a lot more material.
There's July 26. and then there's Jackson Hole. Does all this chit-chat, Mike, change what you believe you'll perceive at Jackson Hole?
Not so far. I mean, I think a lot will depend on tomorrow in the sense that if we get something like 500,000 jobs created, they're going to raise rates. They're probably going to raise rates in September, and Jay Powell will explain it to us all in Jackson Hole. But if it comes in more like the 225 that's anticipated, then you've got open questions about September. So let me throw that out to Andrew here. When you start to model out what happens over the next 6 months, let's just get to the end of 2023. Do they go 2 or do they just go 1 and hold? Are they on every other month? How should people anticipate what the Fed's going to be doing?
Yeah, I don't think there's a strong presumption towards every other month. We saw in the minutes as well as in comments from Chair Powell that they want to moderate the pace, but they're not really telling us that that's necessarily every other meeting. And they want to keep this kind of very data-dependent approach. So I think it's exactly what you said. They're going to look at the labor market data. They're going to look at the inflation data. Like I said, core inflation, the next couple prints maybe are going to be a little bit softer. So that should be somewhat encouraging for Fed officials. On the other hand, this resurgent activity story and this 2% growth that is continuing longer than expected, job growth that stays stronger than expected, that might end up being pivotal for whether they make that September hike or not. I agree with you. If we see anything approaching what we saw in ADP and the NFP reading, then that's probably a strong signal that they will go ahead in September.
I'll get Tom all excited here because he loves to talk about R-star. But part of the calculation going forward, you mentioned the 2% growth that goes on longer than expected. Do you think that the neutral rate is higher and will stay higher than it has been? Or are you in the John Williams Fed camp that says we're going to go back down to 2% and rates can fall down as well?
I mean, I guess maybe you could say I'm in the Laubach John Williams camp, which is a paper that the two co-authors wrote that suggests that you should have this kind of very slow-moving update to where that R-star is, because we really don't observe it. What we do observe is where's inflation, where's growth, and if inflation and growth are coming in stronger than expected, then you should start revising that up. So I am kind of slowly starting to adjust higher where that R-star might be. I don't think we've come a long way there yet. We have to see more data to really know where we end up. If you look at the Fed's dots, remember that long-run R-star in their dot plot came down significantly over the last decade that they've had the dot plot. We're starting to see some of those dots move higher, and I think that's just appropriate given the data that we've seen.
If you're just joining us, it is 23 hours of chaos. That's the only way to put it. Michael McKee is focused on the JOLT survey tomorrow. We'll bring you the unemployment data tomorrow, the 2 jobs reports, this off the shock of ADP. In a market on the move, the equity space down 32 points on the S&P futures. The VIX out of stick 15.28. And the yields, I'm not going to take a lot of time here, but I'm out 9 basis points higher. 10-year real yield, the 2-year yield is a 5.08%. Really remarkable. Andrew Hollenhorst, I just brought up the Citigroup mortgage rate, and it's something like a published 7.07%. What do these yield moves do to housing? And it's to me, we're right on the edge of a jump condition in the cost of money to affect real estate, right?
Higher mortgage rates are going to slow the housing market, and we've seen that over the past few quarters. But that mortgage rate actually peaked back in September, October of last year when 10-year yields peaked. Now we're getting back to those levels again. Yeah. So you can see those same kind of mortgage rates. The issue that you've had is that reduced demand for housing, but it also now has reduced the supply of housing in the sense that if you have an existing home, you don't want to put that home on the market. You don't want to lose that 3% mortgage rate. So what we're seeing in the housing data is a really interesting development where we're actually getting more activity in new housing starts. You're getting prices that are moving higher because demand is lower. But like we were talking about before, the supply is also lower. And as that market adjusts to that, you're actually starting to see some renewed price pressure.
As a general statement, if businesses live in the nominal space, the top line space, folks, not the inflation adjusted space, I'm sorry, it's a jump condition, Andrew. 14 basis points in the 2-year yield, 5.09 percent. How does the business appetite change with the shock of this Thursday morning?
Yeah, we definitely will see this feeding through to broader credit conditions. You see that in the senior loan officer survey. It'll be interesting. We'll get another look at that soon. And you see lending conditions broadly that are tightening. This is just going to take time to work through the banking system and the credit system.
We had a viewer question, but I never get the viewer questions. McKee's the only one that gets the viewer questions. Who's the viewer?
You're getting
is this from which governor is this going to?
You get all the questions.
Is this
on
Krosner
thread.
emailing in?
Well, it's a pretty simple question, and it's probably something I should have thought of to ask you as well. You guys are at 170 for tomorrow, and that's below the consensus. Do you change based on any of this data? How are you going to put it together?
Yeah, I don't think we'll change based on this. And the issue there is what you mentioned, Mike, which is the seasonal adjustment issues. The reason we're lower on tomorrow's number is because this data is so difficult to seasonally adjust. And that seasonal adjustment tends to differ between ADP and NFP. So when we go back and look at this data, I think we probably will end up being weaker on NFP than we were on ADP. And we'll end up attributing that to seasonal adjustment issues.
I look at it, my head spinning. You're going to go back to the office today. Do you guys rip it up, or do you just have to wait to see what 8:30 tomorrow is?
You know, every day it's like we're starting over again. I mean, the cycle has just been so different than anything we've seen. So we take the data as we get it.
And that, I'm going to suggest, describes the central bank of the United States right now. To me, they're wildly ex post, as I've never defined in my mind before.
Yeah, I think that's right. A very reactionary.
And I saw that at Sintra. I think all four they were all struggling to come up with theory. There's no theory here.
Yeah, there is a sense in which the data have just diverged so much from the theory that everyone has become more empirical and more reactionary to the data.
Thank you so much for joining us. Can we see you tomorrow at 8:30? If we get a bang-up number like this, we get 600,000 non-farm payrolls.
Yeah, I'd love to
pick up the phone, take a call. Andrew Hollenhorst with us with Citigroup as well. Michael, Dr. Hollenhorst makes clear he's never seen this. Have you ever seen this?
Not like this. I mean, it's just a completely different kind of economy. And the interesting question is, how long is that going to last? Do we go back to the old rules working again? To talk about our friend.
And that's John Williams, our star.
Our friend Mohammed El-Arian. Do we have a new normal? Do we go back to the old new normal? Do we go back to the old normal? We don't know at this point.
Are you doing threads?
I did sign up.
You did sign up. So Isabel Lee over at Bloomberg News just announced she signed up. She's very brave.
I think everybody's going to try it out. We'll see how it goes.
We'll have to see tomorrow. This is really exciting, folks. You know, forget about sleepy July and the heat that's out there, particularly in New York City. We're not seeing it. We're seeing a 2-year yield 5.10%. Standard & Poor's 500 on a percent basis down 0.8%. This is Bloomberg Surveillance on radio, on television. Michael McKee with us right now to garner wisdom here. I want to go to McKee 101, which as usual, you leaned forward yesterday, Mike, and said we need to lean forward and pay attention to jolts. Review this now. Why is jolts important?
Well, it's important because basically the Fed has hung its idea of a tight labor market on the idea that there's so many job openings that the people are going to have to pay up, and that'll be inflationary to try to get workers. So they've been watching these numbers, and economists have a lot of questions about jolts. The survey response rate is very low, and a lot of these may be repeat job announcements that maybe have already been filled and they just didn't take them down. The folks at Indeed.com who run their own job surveys say their numbers are much lower in terms of overall jobs. They're about where we are in terms of unemployed people. So, does this give Jay Powell a reason to continue to claim that the labor market is really tight, or what do we get out of it? But since they're watching it, everybody else is.
And do the PhDs at the Fed pay attention to the ADP report? That's the heart of the matter.
Well, my guess is they pay attention and they look at the data, but as I said, they have an index that they say is based on ADP data. It's not the ADP report. So I would be very interested. If you're listening down at 20th and C Streets, send me that number. I would be very interested to see how it differs from the number we got.
The 10-year real yield, 1.80%. That is a wow statistic. That's all the reason you need to stay with us through the coming day. The conversation here as we go to the jobs report, we'll do that tomorrow at 8:30. We'll go beneath the headline data. We do that with Michael McKee. This is Bloomberg on radio, on television.
You know, it's an interesting time because no one expected what happened in the first half. I would call myself more of a sober bull at this point. There's risk in the market. It's clear that there's a lot of risk in the market. I'm paying attention to the bond market. I'm paying attention to a lot of the economic data. Not all that suggests things are great out there.
Ann Maletti, Ace Value Manager at Allspring Global Investments. She's paying attention to the land of Ira Jersey. So is Gina Martin Adams. We're never going to admit that Ira with his 201k is probably paying attention to the Gina Martin Adams world. But they are here to synthesize this. This is an important conversation. As we mentioned Dominic Constam earlier, Ira is a young whippersnapper, worked for Constam a few years ago at Credit Suisse while Gina was holding court. I think it was at Wells Fargo. And we've got here real bond and real equity perspective given the tumult. Let me define the tumult for you right now. And this goes to Newtonian calculus. Because of that, Gina, I'm going to you because Ira's like weak at math. The basic idea here is a 2-cent spread hasn't moved 107 basis points. A 10-year real yield's a rocket ship out to a 1.80%. 2-year yield up 16 basis points. These are wow moves in the bond market. When you get gamma in bonds, Gina, what does it do to the equity market?
Yeah, well, it depends on the offsetting impact on the economy, frankly, because earnings are the primary driver of stock prices. But you do see when you have very significant moves in the bond market, you usually see it play out through valuations, suppressing in particular the longer duration assets in the equity market, those with cash flows concentrated much more distant into the future. Now, the interesting aspect of 2023 is we're not seeing this necessarily happen this year because of the earnings landscape, which is significantly offsetting a lot of volatility that still exists in the bond market. Also, because 2023 is so polar opposite in difference in terms of margins to what we experienced in 2022. So even though the bond market is experiencing a lot of movement, the equity market has other factors to tie to. AI driving earnings, compressed inflation spreads helping to stabilize margins and the like. As long as you have pretty strong job growth as well, any concerns about revenue growth for the equity market are diminished. So the equity market has other factors to kind of tie to right now.
Years ago, Ira, Constant would lean over his desk and turn to you and say, which number on the BTMM screen matters? Ira Jersey, which number on the BTMM screen, the great Bloomberg money market screen, matters to you at this moment?
Yeah, so, well, all of them matter at some level, Tom, as you know that I was going to tell you. But what's going on in the repo market matters quite a lot because a lot of these moves are much larger than you might think given just given the data that we've received. So liquidity is certainly something that's on the minds of a lot of people in the bond market right now. It's a holiday shortened week. We have a big data number tomorrow. Not a lot of people want to take risk and probably want to get out of some risk before tomorrow's jobs report. And then on top of that, you've had a weak Europe because now they're talking about more rate hikes in the UK. So maybe going up to 7% in the UK. So Hugh Worthington, our colleague in London, is flagging that as one of the reasons that this sell-off started overnight quite dramatically.
Are we in a jump condition? The fancy talk here, folks, is you have glide path, smoothness, which indicates stability. If I take the 2-year yield back 3 years, Ira Jersey, can we now state with this breakout a jump condition?
Well, we've certainly jumped a lot in a short period of time, and we keep doing that as we reprice where the Federal Reserve is going to ultimately end up in terms of its hiking cycle. So now we're almost fully priced for that 50 basis points of hikes that you saw in the dot plot. There's still a lot of data to go before we get to the September or November meetings in order to see if the Federal Reserve will ultimately make that second hike. But when you get data like this morning's ADP report, it's almost you almost have to think it's a done deal that the Fed's going to move again in July at least, if not again.
Gina, 5.09% on a 2-year, that's a ginormous 15 basis point move. What's it mean for Diamond? What's it mean for Moynihan? And what does Bloomberg Intelligence say about the dynamics of the financial statements of our big banks?
Yeah, I mean, without a doubt, the banks within the financial sector are not one of the preferred segments, given the yield curve signals, as well as general credit distress in certain segments of the economy. When we run our broader financial models, we actually find that some of the consumer finance companies, some of the insurance companies tend to filter toward the top, leaving banks far behind, given the dynamics of the yield curve, as well as this potential for defaults and ongoing risk emanating out of the regional banks.
Gina, are we going to see, I mean, you talk like that, and I think of Visa just has been a huge performer. Good morning, Meredith Whitney, who nailed that call a million years ago. Gina Martin Adams, am I going to see 33%, 35% annual charge card rates?
Look, it's certainly not within my purview to finance. I do think we are seeing the cost of borrowing go higher and go higher very, very quickly. At the same time, we're seeing the amount that consumers are able to get on deposits rise very, very rapidly as well. So it really depends on the degree to which the job market slows down, suppressing wage growth, forcing consumers to go out and borrow. I think it's worth noting that borrowing overall is still at a very, very low level relative to income. Debt service relative to income is at a 40-year or near a 40-year low. So there's plenty of capacity to borrow, but it will without a doubt cost more to borrow money going forward, given where interest rates are. There are offsetting factors, and it's important to note that's not the only decision that consumers will be forced to make. In particular, the job market remains very strong, wage growth remains relatively steady, and inflation pressures come down. Those factors can offset the cost of debt.
I mean, Ira, the bond strategist Gina Martin Adams gets to the heart of it, which is we're all living very, very quickly. I mean, that's what I'm seeing right now, Ira. Define very, very quickly in your world, and what will it do to mere mortals that are watching?
Well, I think very quickly is, as you saw this morning, almost instantaneous. The market right now is kind of confused, and I think a little bit fickle. We see some of the data on inflation, for example, continuing to trend a little bit lower, but then you get data like we had this morning in the ADP report, and people are worried that you might see a reacceleration, or if nothing else, maybe a flattening out of the level of price growth in the economy. Continue to maybe stay at 4%, right? So in an environment like that, I think the market's continually reassessing where is the Federal Reserve's terminal rate, and we all thought, well, most of us thought it was 5% plus or minus 25 basis points. Now we have to reassess that because we've gotten to that 5%, and the question is, can we go to 6 now? Is going to be the next question that I think the market's going to ask itself. Can we go to 6 now, Ira Jersey? I don't think so, but then again, I didn't think we'd go to 5.5, and now, now I have to reassess whether or not we're going to get to 5.5, and I think that's a distinct possibility.
Gina, Dan Ives was in this morning. He absolutely nailed the tech rally of 7-8 stocks. He gets lucky once every decade. You know how that goes, Gina. And he talked about ecosystem. There's been a lot of zeitgeist, Gina Martin Adams, in the last 3 days about how older people in America have loaded the boat in the equity space. Do you agree with that? That everybody owns stocks in our ecosystem? Is stocks ever higher?
I think if you look at the broader statistics, you actually find that less than 50% of U.S. households actually own stocks. Net households have not added to their equity positions in more than 20 years. As investors were burned by the tech bubble. So we're talking about, you have to go back more than 20 years to the peak in equities holdings as a share of overall household holdings on net basis. Certainly those investors that were able to ride the wave of the equity market and weather the storm of 2000 and then again in 2008 have benefited from that. But they've been riding it. They haven't net added to those positions. So I would take a little bit of issue with this idea that investors are over allocated to the equity market. They certainly are holding, and that has benefited them, frankly, as equities continue to sort of perform significantly better than many had anticipated, tied to growth.
I mean, Ira, you taught me the 30-year yield function here. and I'm looking at the intraday on the 30-year bond. That used to be the benchmark. Young Jersey doesn't remember. We didn't get to 4%. Ira, what's my mortgage rate in 2 weeks?
Oh, it's going to be a little bit higher, that's for sure.
Thank you. Analysis there from Ira Jersey of Bloomberg Intelligence. And Gina Martin Adams, thank you so much. You know, folks, we said it's going to start slow. This is nuts. We'll see you tomorrow. By then, I'll have more Threads followers.